matumaini tujitahidi, tujivunie, tuendelee mbele, twende mbele, 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 tuendelee twende mbele, 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 twende mbele, mbele, Kenya twende mbele, Kenya tuendelee, twende mbele. NCBA, go for it.
In today's fast-paced world of business, your banking platform should keep up, or better yet, move faster. That's why we're excited to introduce Connect Plus, the smarter, faster way to manage your banking needs. With Connect Plus, you get seamless access securely on both web and mobile, all in an easy-to-use, intuitive interface, whether you're at the office or on the move. And if you ever find yourself without internet, don't worry. Our offline processing feature keeps you up and running without missing a beat. Here's what you can do with Connect Plus. Get a clear view of your finances with dynamic dashboards that give you all the key information and insights in one place, so you can make smart, informed decisions. Optimize your cash flow by pooling balances across different accounts and managing your liquidity with our top-notch service. Handle all your bulk payments easily, from domestic instant transfers to statutory payments to international transactions across multiple currencies. You can even fund multiple corporate cards instantly. Manage all your mobile money needs on the go with our mobile money feature. Purchase M-Pesa float, do Lipana M-Pesa, and manage your mobile payments in real time. Invest just in time in government securities with a simple, smooth process using the Dow CSD investment payments feature. Simplify collections by managing insurance premiums or other recurring collections with our improved direct debit mandate upload and processing features. And stay in full control with real-time payments, streamlined collections, and complete visibility of your cash flows. With real-time payments, just-in-time investments, simplified collections, and full visibility of your cash flows, you're always in control. Welcome to the future of banking with NCBA Connect Plus, your smarter, faster, more efficient business banking partner. NCBA, go for it.
We are actually an organization working on food and nutrition security, water and sanitation and hygiene, and all actual advocacy, humanitarian actions, skill up and economic development. These are actually the main area of actually WHH focus. So as head of finance, I'm entirely responsible for the function and operation of the WHH. Entirely, I'm responsible for the whole program, reporting to donor, entering data in the system, fund requests, dealing with the bank. All these are actually my responsibilities. Okay, NCBA is the most efficient bank for me. They have a good system and a good team. So my experience is very good. They're really fast, quick to give solutions. I came to know NCBA, at that time it was 2016, when I was in charge of South Sudan program. 3 or 4 months ago, so we smoothly implemented Connect Plus without any challenge. With the support of your team, so we mastered it. The most important thing is swift, actually, the payment process from initiating up to approval process, very fast, quick, both domestic and international payment. Like for example, after we did the transaction, initiate, approve payment, you can see the balances, you can see the audit trails, who initiates, who approves, with the second approval, everything is there. That's the advantage. So it helps actually to know liquidity, our balance for a decision making.
Some of the features that has really stand out in the NCBA Connect Plus as e-receipts, where you find that immediately the payment has been approved, you receive the e-receipt via an email. We also have a prompt. This is good because it asks you before it logs you out, so you have more time compared to the NCBA Connect, and this is good for us.
On the new platform, we have the cloning part, where we have initiated a payment for the first time. We don't need again to come back and redo the payment. We have the details there. Just change the amount, and the payment is done.
Definitely, I would recommend NCBA Connect Plus to others because it's simple, it's secure, it's user-friendly, and it streamlines the transactions. It also makes transactions easy. You're able to make your reconciliations faster.
If I could describe NCBA Connect Plus in my own 3 words, I could say it is simple, it is efficient, it is secure. NCBA, go for it.
My roles are in finance, is budget and control, financial reporting, cash flow management, regulatory issues in form of taxes and debt collection, ensuring that we have money in-house on time. I've worked with NCBA for the last 9 years, and I've seen Mediamax as a company grow when we're using the services from NCBA. We've been given credit facilities, and they're managing our loans. We are where we are because of NCBA. With the old system, we had challenges like the system being a bit slow, and then there were things like statements. We need to go right to the bank to get statements for prior years. Getting the forex rates, we have to call the bank. We have used Connect Plus for the last 4 months, and the experience is quite good. It's a holistic approach NCBA has used. You want statements for the last 3 or 4 years, you directly get them now. We don't need to call the bank.
With Connect Plus, we are able to get the bank balances in time, therefore enabling us to balance our cash flows and make payments appropriately.
NCBA looked at what their users want. So they to innovate it in a way that it's not only user-friendly to the people working at the bank, it's also user-friendly to the customers. I will recommend NCBA Connect Plus to any other person because of the enhanced security features. It's simple, it's direct, so you don't need to go for training. It's something that you learn from your table.
If I were to describe Connect Plus in 3 words, I would just say, just wow.
My roles are in finance, is budget and control, financial reporting, cash flow management, regulatory issues in form of taxes and debt collection, ensuring that we have money in-house on time. I've worked with NCBA for the last 9 years, and I've seen Mediamax as a company grow when we're using the services from NCBA. We've been given credit facilities, and they're managing our loans. We are where we are because of NCBA. With the old system, we had challenges like the system being a bit slow, and then there were things like statements. We need to go right to the bank to get statements for prior years. Getting the forex rates, we have to call the bank. We have used Connect Plus for the last 4 months, and the experience is quite good. It's a holistic approach NCBA has used. You want statements for the last 3 or 4 years, you directly get them now. You don't need to call the bank.
With Connect Plus, we are able to get the bank balances in time, therefore enabling us to balance our cash flows and make payments appropriately.
NCBA looked at what their users want. So they to innovate it in a way that it's not only user-friendly to the people working at the bank, it's also user-friendly to the customers. I will recommend NCBA Connect Plus to any other person because of the enhanced security features. It's simple, it's direct. So you don't need to go for training. It's something that you learn from your table.
If I were to describe Connect Plus in 3 words, I would just say, just wow.
West Valley Sugar Company is able to do 1250 tons per day cane, which we are going to produce about 2,000 to 2,500 bags of sugar. That is in a daily basis. We get our sugar cane from the Kericho region, Kericho, Nandi, and Nyando, actually the Nyando zone. Currently, we have about 7,500 cane farmers. They range from 1 acre to even 1,000 acres. But the bigger range of the farmers we are looking at are the small-scale farmers, 1 acre to 5 acres.
In terms of the contribution to the area, you just look around the area, you see a real town is coming up slowly. You can see people's lives are changing for the better. This factory is employing a lot of locals. NCBA's commitment is that it will continue to support the development of local industries, the development of local factories like this. And certainly in so doing, we also support the supply chain, such as the farmers,
The elements of the EDP program that we admire is the diversity and inclusivity that it offers, from age groups to the range of businesses, to the types of businesses, to your grades of maturity of your business, that surely encourages you through the journey. You know, those that have run it for 10, 15 years, you see, mine is 3 years old, it is possible I'll get there. Some are very new and you realize they're dealing with problems that you solved, and I hope that interaction and the projects and work that you've done together has richly enriched that.
Who are not differentiated, and you are able to uplift the others through your contribution to society. So we expect you, once you have competency, you have good character, you will contribute to a better society, a better country, a better continent.
Most of the customers are enthusiastic about it. And so the fact that we are able to supplement the school fees, they are also able to network. With the many challenges, the answer is not always financial. Education and empowering yourself and also your employees is very key for the success of your business. So we encourage you to enroll to this program, get the benefits researched and placed to benefit most of the SMEs.
Kote nchini matumaini, tujitahidi tujivunie, tuendelee mbele, twende mbele, 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 tuendelee. Twende mbele, 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 twende mbele, tuendelee. Mbele, Kenya twende mbele.
Kenya,
Tuendelee.
twende mbele. NCBA, go for it.
The beautiful display of vehicles, spare parts, trucks, it's really mesmerizing. When you go around and look at the beauties which are here, they are just blowing your mind off, yeah?
The innovations that have been done since 5 years ago, just going around the new vehicles we have seen, talks of hybrid, talks of electric vehicles. NCBA has been at the forefront of driving electric vehicle adoption in this country, setting aside 2 billion shillings to support customers who want to acquire electric vehicles. And more recently, we announced that we are going to be rolling out charging stations. And indeed, we have already rolled 2 in our main center for customers and for the public.
That whole new infrastructure of electric motorbikes, electric vehicles, is an area that we would like us to invest. Investment in new battery making technology. We would like to position Kenya as the manufacturer of electric motorbikes for Africa.
As we progress and develop the infrastructure, all the importers of new vehicles are actually gearing up to bring their different models of EV vehicles. And very soon, you will see at least 4 or 5 different brands putting forward their EVs on the road.
NCBA is the biggest financier of vehicles in this country. We like to brag that when you're driving, just count 3 cars ahead of you. The third one is probably financed by NCBA.
In today's fast-paced world of business, your banking platform should keep up, or better yet, move faster. That's why we're excited to introduce Connect Plus, the smarter, faster way to manage your banking needs.
Ladies and gentlemen, shall we take our seats? Let's all settle down, please. And once again, it's my delight to welcome all of us to the 2025 NCBA Economic Forum. Are we excited to be here? Are we excited to be here? Fantastic. I hope you've had a nice biting and drink this breakfast. And before any further ado, it's my distinct honor to welcome all of us to rise on our feet for us to have the national anthem and the East African anthem. Let's rise, please.
O God of all creation, blessed is the Lord and nation. Justice, leadership, and defender. May we live in unity, peace, and liberty. Plenty be found within the borders.
Mungu twaomba
tutimize na malengo yetu. Jumuiya yetu sote tuilinde, tuwajibike, tuimarike. Umoja wetu ni nguzo yetu, idumu jumuiya yetu.
You may take your seats. Ladies and gentlemen, once again, good morning and welcome to the 2025 NCBA Economic Forum. I dare say this is the premier platform where we come to have economic discourse, whether it is global, local, or regional. And it's a delight to be captaining this ship one more time. Before I invite Nelly Wainaina to do some scene setting for us, allow me to give some basic housekeeping. I'd like to request all of us to have our phones on silent mode to avoid disruption of the program. In case you want to visit the rooms of convenience, kindly exit via this door, turn to your right and walk to the extreme end, and there you'll be able to get assistance. My name is Julian Amboko, and I am a go-getter. And if there you are, say it again. Thank you very, very much. Allow me to lay the protocols before any further progress. The chairperson of the President's Council of Economic Advisors, Dr. David D, who will be joining us shortly. The Group Managing Director and Chief Executive Officer of NCBA, Mr. John Gashora, here with us. The Managing Director, NCBA Bank Kenya, Mr. James Gossip, who is also in the room with us. NCBA board members and leadership present, NCBA colleagues, Government of Kenya representatives, Central Bank of Kenya representatives, Kenya Bank Association representatives, research partners, including AERC, among others, distinguished panelists, esteemed partners and analysts present, our esteemed customers physically present here and those joining virtually, invited guests, members of the Fourth Estate, my colleagues, welcome and feel at home. We shall be having a very enriching conversation this morning. And at this juncture, allow me to welcome on stage Nelly Wainaina to give us the scene setting. Karibu sana, and let's appreciate how she makes her way here.
Good morning, everyone. Good morning. So the last time we were here, and I'll ride on the protocol that has been read by Julian's. My name is Nelly Wainaina. I'm the Group Director, Marketing, Communication, and Citizenship at NCBA, the bank that says go for it. We have our executives here. We have Mr. John Gashora, our CEO. We have James Gossip, our MDK for Kenya. We have our leadership. We have our esteemed customers. We have members of the press who are really good friends of the Economic Forum. And I remember last year at the same time, we had the US elections. So I was wondering to myself, what is it with the Economic Forum for NCBA and elections? Because last year was the US. We have seen how that has gone. And this week is a Tanzania election. And we have seen how that goes. So it's really, really amazing that we are having conversations at the right time. What do the macros globally and in the region and locally mean for our consumers, which is why we are here today. Ladies and gentlemen, welcome to the 10th Economic Forum by NCBA. I believe we are also here to see a very special guest who we are waiting for, Dr. Ndi, in person. And we are looking forward to amazing insights from him. On behalf of the board of directors, the leadership, the members of staff at NCBA, I welcome you all and thank you for joining us this morning. I was asked to also brag a bit about NCBA because you bank with an amazing bank. You are our customers. We are because of you. So here are a few things I was asked to read out on NCBA, which make us an amazing, amazing bank. We are the largest bank in Africa by customer numbers, over 60 million customers through our telco partners. So that's a big thing. We are the only East African bank in West Africa. That's another big thing. We are the home of asset finance. So every other car out there is financed by NCBA. We have more than 100 branches. We have more than 100 branches, And with our partnerships with Postbank, we reach as many consumers as possible across Kenya. And finally, we also are the bank that brings you innovations. So you can now open an account with NCBA digitally. That is amazing, amazing, amazing. Karibu Daktari. Thank you so much for being here. He's now here. Thank you so much. I was just talking about the elections, Daktari. Last year was the US elections. This year is the Tanzania elections. And so I'm sure we'll have some conversations on how some of these macros are affecting our consumers. The second scene setting for today. What is worrying our consumers globally? So we have a report from Ipsos that says the top 5 things worrying our consumers, and these would be the answers they're looking for from this forum. Number 1 is crime and violence. Number 2, inflation. Number 3, poverty, social inequality. The 4th one is unemployment. And the final one is financial and political corruption. Those are the things that worry our customers. So when we have the conversations today, how will those answers and the insights help our customers navigate the things that worry them? And finally, we are looking for inspiring questions, interactions from everyone. And I personally have a question which is linked to the Kenya shilling that has been stable, very stable. And the question every consumer or customer is asking, what does that mean for me? What does that mean for us, wananchi? At 129, I hope Kwame and the team will be able to tell us how that is affecting our customers. But interestingly enough, the Business Daily yesterday said the IMF raises alarm over static Kenya shilling versus the dollar. So I wonder, is it stable? Is it static? And so Raphael, you would be able to let us know and confirm what that means. Ladies and gentlemen, thank you for joining us. Thank you for your continued trust in NCBA. And remember, whatever the challenge, whatever the opportunity, go for it. Thank you very much. And it is now my pleasure to welcome the owner of today's event, our Group Director, Corporate and Investment Advisory Banking, to address us, Mr. Tyrus Mithiga. Karibu.
Thank you, Nelly. Good morning, everyone. Allow me to stand on the protocols as established and welcome you all this morning to the 10th edition of this economic forum. As you've heard, my name is Tyrus Mithiga, Group Director for Corporate and Investment Advisory Services at the bank. This forum has become one of the most trusted platforms for dialogue and insight in Kenya's economy, the global story and the geopolitics that impact all of us. Over the past decade, we've shaped through this forum strategic conversations that connect knowledge, data and decision-making across all of the industries that we operate. And in fact, public opinion around some really topical issues of the day. This year's theme, 2026 macroeconomic outlook, managing the trade-offs that are needed to promote growth and resilience, is timely and relevant given today's economic environment. At NCBA, we believe that sound decision-making is built on honest dialogue, shared insight, and the partnerships that we can bring to the table that enrich the quality of your conversation, both at your management and board levels. This forum is one demonstration of this belief that growth comes from collaboration when business leaders, policymakers, and investors engage openly on issues that affect our lives and businesses. Over the years, this forum has enabled critical conversations on issues such as inflation, fiscal reform, productivity. I believe 2 years ago, Dr. Ndii clarified for the first time that Kenya wasn't going to default. And he said that and posed for effect. Those of you who are in the room will remember that that was a seminal moment, I think, at the time. These dialogues will continue to inform business strategy and policy direction, and it is our commitment from the sponsorship of the Corporate and Investment Bank but also the bank generally, that this is a platform that must continue to grow and mature. At NCBA, we therefore will support you post the conversations that follow. Much of what you'll hear from our economist, Chief Economist Raphael, our Head of Research, Anthony, is available to you as a corporate client if you need that conversation to extend to your boardrooms, for us to share our insights about your sectors and so on. At this point, I'd like to recognize the clients that are in the room. I see a lot of friends across all of the sectors that we bank. Telecoms, I see aviation, I see transport sector itself, oil and gas, I see agribusiness represented here, clients from our retail business in commercial and SME banking, clients from our priority banking coverage sector, and in fact, our investment banking clients as well. But I'd also at this juncture like to very briefly ask my colleagues that support you all, who are all in the room. We don't have time to introduce, but if you can just stand and wave from wherever you're seated, my colleagues in the relationship. Oh, did I switch it off? Yeah, and if you've got any questions or comments or feedback, I think that's why we're here. Please engage with us. I'd also like to recognize my colleagues in the executive that are in the room. If you could also just briefly stand and wave. My colleagues in the executive team, Rafa, Isaac, Muathi Kilonzo, thank you very much for being here. This morning we will hear from an eminent panel of, or maybe the eminent policymaker, anyway, we'll see, or we've seen, analysts that look at our economy and have studied it deeply from the think tanks and the research institutions that they run, industry captains that are trading in this environment and who will share their view, partners from our bilateral partners that will also share their perspective, and our leadership from the bank, which briefly and quickly now takes me to the job that I was asked to do, which is to welcome my boss, our Group Managing Director and Chief Executive, John Gashora, to make his remarks and progress with the program. Thank you very much for your attention, and karibuni tena.
Thank you, Taras. Thank you, Nelly. Thanks, Julians. And if I may just write quite a bit on the protocols already established, but do allow me to recognize our keynote speaker today, the chairperson of the President's Council of Economic Advisors, Dr. Devin D. I also see he is joined by one of his colleagues, Mr. Hassan. Thank you for being here. I also want to recognize our panel today. Thank you very much for being here. We don't take it for granted. And to thank all of you and to say good morning. Let me welcome you to the Economic Forum. And before I delve into matters economy, I also apologize for the late start. And what I'll ask of you is patience. We have a great panel to listen to today. Please do move your meetings that were going to happen about 11 o'clock. I think you can call and move them to a little bit later, giving time to understand where we are. I also want to introduce the NCBA ExCom in the room. So if you're from NCBA ExCom, if you could stand and wave very quickly. A number of colleagues. This leadership of NCBA. I do want to recognize especially and introduce, if James, you can remain standing a little bit, Mr. James Gossip. He is our Managing Director for NCBA Bank Kenya. So if your credit is not getting approved, please stop calling me, call him. And if you need people employed, please call him as well. Yeah? Really join me in welcoming James Gossip into the organization. Thank you. So, ladies and gentlemen, it's always a pleasure to connect with all of you at this thought leadership platform. where we exchange ideas on the macroeconomic environment, and that we find ourselves navigating in these times. At last year's forum, I spoke about the key trends that in our minds were likely to influence the economic and business environment in 2025, with the context of what was already shaping up as heightened uncertainty on the back of the transition that was anticipated in the United States, particularly the rhetoric on global trade that dominated the presidential election there. And true to our forecast, the global economy has turned out to be quite uncertain in 2025, with the climax being the famous Liberation Day, where Trump tariffs were unveiled. It was just April of this year. So since the start of the year, several major policy shifts have occurred, and trade tensions have continued to deteriorate, leading to market volatility across all asset classes as prices yo-yo to reflect the latest pronouncements from the Trump White House. Despite this, so far the global growth remains on a solid trajectory in 2025. So even though the global economy has cooled a notch by expanding at just about 3.2% relative to 3.3% in 2024, all things considered, growth looks to be on course for a relatively good run this year. In some ways, this performance may be seen as a reprise of the past 2 years, where the global economy continues to defy broad expectations for sharp slowdown, defying most forecasts. Nonetheless, we believe that there is still another shoe that may drop next year, considering Donald Trump's determination to reshape the post-World War II global trading system. We believe that the trade tariffs could still impair economic activity in 2026 and is likely to bring further softening in US consumption and import demand. In this regard, according to the October 25 edition of the World Economic Outlook report from the IMF, the US and emerging and developing Asian economies are projected to grow much slower in 2026 at just 2.1% and 4.7% respectively, compared to 2.8% and 5.3% respectively that we observed in 2024. Slower growth in some of these advanced economies may result in lower demand for Kenya's exports, as well as reduced diaspora remittances, even as fiscal financing needs for development remain large following increased expenditure priorities. Against this backdrop, Kenya's near-term growth model that is still heavily dependent on public expenditure, agriculture, and service sector resilience faces considerable challenges. Moreover, as we are all aware, the country continues to struggle with high public debt, interest costs, and refinancing needs. In the first quarter of this year, just to illustrate, of this fiscal year, the government spent 509 billion on public debt service, out of a total tax collection of 554 billion. This strain on public finances limits the government's ability to finance critical infrastructure spending, as well as build fiscal buffers necessary for an even more durable macroeconomic stability. That in today's constrained fiscal environment, demonstrating efficiency in public spending is crucial for the sovereign to deliver greater value for money to citizens cannot be gainsaid. It is quite heartening that policy pronouncements from the ruling administration, and I'm glad we have two of the foremost policymakers in the room, the pronouncements do seem to be quite alert to these priorities. On the monetary policy side, we have witnessed very prudent management of the key prices necessary for macroeconomic stability. The focus in 2026 will likely be on the extent to which the Central Bank of Kenya can continue with the ongoing monetary policy easing as they seek to reignite private sector credit growth while keeping inflation within target. In this regard, the new risk-based credit pricing framework that banks are going to be rolling out is highly welcome. Although inflation has been on a downward trend in 2025, and inflation expectations appear well anchored, there is a risk that this could be reversed by kinks in the inflation data due to food price inflation, especially given the heavy reliance on rain-fed agriculture that we have as a country. Moreover, maintaining the current healthy foreign exchange market liquidity into next year remains crucial for not only the monetary policy makers, but for all of us. And to that, I draw you to the attention of a headline that appeared this week from the IMF talking about the stability of our exchange rate. And I know that's becoming a conversation of many dinner tables, that the shilling has been extremely stable. In this context, coordinated fiscal, monetary policy is imperative to anchor the growth momentum. A credible public debt anchor with a sustainable mix of domestic revenue and concessional financing is essential to support inclusive growth under the bottom-up economic transformation agenda. This is why our discussion today is focused on managing trade-offs to promote economic growth and resilience. Indeed, today's forum, themed 2026 Macroeconomic Outlook - Managing Trade-offs to Promote Growth and Resilience, could not be more opportune. We all need to collectively become agile and focus on building resilience and lifting growth, which is key to raising living standards and creating jobs. Hopefully, we can collectively help shape the right economic growth path for our country, for the prosperity of all our people, given all the trade-offs that we need to make. And this is possible. Inasmuch as international trade uncertainty persists, Kenya's export flows are to a considerable degree diversified across various markets. To be sure, only 8% of Kenya's exports were destined to the US market last year, with 38% going to African markets, 15% to the Middle East, and 20% to Europe. To this end, the East African community should continue to pursue lower barriers to trade to allow large farms to reach scale, as well as accelerate innovation efforts. Again, I draw you to an article that appeared again this week in one of the papers talking about the fact that Kenya probably has not been treated fairly in the policies of the East African community. And being such a trading bloc, a large trading bloc for us, that becomes an important thing to look at for policymakers. We'll be glad to support not only large and established firms that increase the region's productivity frontier, but also disruptive new entrants that challenge incumbents and could become leading firms in the not so far distant future. Into next year, we project that favorable global commodity prices will support both export earnings and lower Kenya's import bill. Notably, coffee prices are expected to continue to trade at a multi-year high of about $7 per kilo, supporting farmers across East Africa. And for those who remember the quail story, coffee takes about 5 years to start maturing, so don't go start planting today. It will take a while. Moreover, export quantities of horticultural products, especially into Europe, will remain steady following the extension of the European Union deforestation regulations by 1 year for micro and small enterprises, and a 6-month grace period granted to large and medium-sized exporters. However, tea is likely to struggle on price, averaging just about $2 a kilo. And I think the reasons for that is because Europe is not actually our tea, it's not a main market for tea. I think our main markets happen to be places like Pakistan, Egypt, Sudan used to be one of them, Iran, and a few others. On the fiscal side, the government is expected to work towards reducing its cost of public debt. Resultantly, the sovereign is expected to pursue several external financing options, and I'm sure Dr. D might mention some of them, amid challenges on fiscal consolidation agenda. Hopefully, preparation for the upcoming 2027 general elections will not result in increased fiscal spending pressures and derail spending rationalization efforts and reform implementation. I think that's more wishful thinking than reality, isn't it? We know that when you approach an election, fiscal consolidation gets thrown out of the door. That's usually a reality. While we know that given the current socio-political context, any attempt to raise new taxes into the 2026-2027 fiscal year is likely to face headwinds from the public. The external environment and the reversal of US monetary policy has positive implications for Kenya's fiscus. Again, I hope the policymakers in the room have heard that very strong statement. Any attempt to introduce new taxes could be problematic. This is where we pass messages, isn't it? It's important messages to keep passing. Certainly, optimism around the fiscal trajectory, therefore, remains measured as the recent successful liability management operations by the central bank continue to showcase, but was very, very successful, I must add. Overall, today, Kenya's economy holds several bright spots, which are expected to support the economy in 2026. A strong outturn is expected in the service sectors that includes telecommunication, transport, and domestic trade subsectors. Similarly, the public sector will be crucial as the government plans to mobilize funds for planned major infrastructure projects through PPPs and hopefully enhance liquidity in the private sector by settling a significant part of the pending bills. However, growth in the manufacturing sector is likely to remain mixed, with the food sector more resilient. Ladies and gentlemen, therefore, according to our in-house projections, we now expect that overall output will close at 5% in 2025. This is an up revision from our earlier forecast that we announced last year of 4.8%. So it's a very good welcome revision. This follows an improved private sector credit growth in the third quarter, as well as increased fiscal spending since July. Following this improved momentum, we see economic growth in 2026 closing at 5.1%. Within the context of Sub-Saharan Africa's growth numbers, and in view of all the trade-offs at play, this outcome would largely be on trend, and absolutely welcome. So to give us further insights to these projections, please allow me to invite our Group Director, Global Markets, who is also a Chief Economist, to shed a bit more light on the work that economists have done to come up with these projections, and then I'll come back to close. Thank you. Welcome, Rafa.
Thank you, John, for that outline, and morning, everybody. It's always a pleasure to see all of you at this forum. It's turning out to be an annual event. Joking that it's David's annual address to the private sector. So, and we're very pleased about that as well, given where he sits in the anchor of policy for Kenya. John has gone into a fairly amount of detail regarding our forecast, which is for how we close 2025 and outlook for 2026. I'm aware that we are about 30 minutes late, and just sort of respect for your time, I'll try and claw back some of that time. So that means I'll be very brief. But maybe just to provide the assumptions informing that focus, and probably talk a little bit to the outlook as a pace setter, or just prefacing the conversation that will come from David. So it's about midterm for those who come from the political side, for the Kenya Kwanza team, David and the rest of them. And I think it's fair to sort of take a look at what's been done so far and how we've fared, hence the input into some of the assumptions that we are making regarding that macro forecast. I still argue that all considered, it's a fairly reasonable number, especially if you look at sub-Saharan African averages, but more particularly if you go back to the context in which the administration came into office, which was massive and unprecedented macroeconomic shock coming primarily from the external side. And some of the credit that I think I would want to give them readily is how that has been addressed, and John spoke to some of it. So the Kenya Kwanza ran on something that I think David repeatedly reminds us of, they call the plan. And the plan had a very good, what I think was a very good diagnosis regarding Kenya's macro predicate at the time. And I think they pointed out to three things. Sorry. I'm not going into the slides yet. I may not need to. They identified what they called a perfect storm. All right. At the time, if you recall, about 2 years ago, or 2022, on the back of some of the development paths that we'd taken, rather our development agenda to be precise, the exposure coming from the external side caused a serious storm. So the first thing that happened, of course, is you had a significant shock. Post-COVID, they identified correctly in the reversal of interest rates, given that we'd gone into international capital markets, that reversal on the back of heightened inflation, of course, was a significant shock to public finances. So that was the second thing. And then there's a structural problem that I think David very eloquently again explained in this forum regarding how we got there in terms of just the real imbalances on our real economy. And so together, we found ourselves having to address an unprecedented macroeconomic instability question. And I think in trying to focus Kenya's growth path, particularly near to medium term, we have to always bear in mind that that macro stability question is a necessary ingredient into any assumption that we make. And if you look at the key prices today, there's about three of them, whether it be it inflation, the interest rate itself, and the currency. I think John and even Nelly alluded to that. The prices have been managed very well. All right, so into the midterm, the stability question, I'd argue, with respect, has reasonably been delivered. Brings me to the second point, which is that same external environment, how does it look now? Because that's where the rain obviously started beating us. In a reversal of fortunes, and maybe, David, you guys are lucky or maybe not, but the external environment, counterintuitively, despite those Trump tantrums that John is alluding to, is actually working significantly to Kenya's benefit. Why do I say so? Donald Trump, and I think we're still dealing with the consequences of Donald Trump, including last night. Donald Trump is reshaping our ordinary understanding of central bank, not only independence, but the ability of the central bank to move in whichever direction they think. So if you look at the Fed decision just yesterday, we are down to 3.75, again, reversal from where we were, say, 2 years ago when Kenya Kwanza got into office. But more importantly, Donald Trump is trying to change the constitution of the Federal Open Market Committee. And he may very well achieve that. And with that change, what they promise, for instance, his first appointee to that committee, Stephen Meron, has given us on authority, actually, in his dissent, just as late as yesterday, he dissented from the 25 basis point decision. He's arguing for even sharper. In their sense, the Fed funds rate should be about 200 basis points lower than where it is. What that means is that external financial conditions to our benefit has changed dramatically, quantum reversal from what we saw as they got into office. So that history is important, because if we can take plausibly the notion that macro stability is much better now, then we go on back to the implementation of the plan, which David will speak to. But I think in our every sense, we see from the monetary policy side particularly, a very, very deliberate and we think agile sort of management of the key prices. And as long as that continues, Kenya's long-term, let's say medium-term trend performance is achievable. Hence the number that you're seeing, a revision to 5 and on moving on to 5.1% in 2026. So in terms of the implementation of the plan itself, I think I'll leave that. I'm aware that a lot of you are waiting patiently for David's rendition on that. But if I go back to the external side and the currency, again, it's a complete reversal of fortunes. All right. So we got into, this administration got into office with a reeling shilling. Shilling was north of 160. David may have forgotten this, but at the point when they were debating getting into office, he was suggesting we could even end up at 200. And it was plausible. But on the back of that, a significant FX liquidity crisis that's since been solved. All right. So if you look at the state of reserves currently, including just the liability operations of just a couple of weeks back, we are handing at all-time high in terms of reserves, well in excess of 12 billion. So again, that key price, to the extent that is necessary input into this growth process that we're making, is very, very well delivered. So to save time, I think what we're suggesting is the midterm into their administration, there are a couple of positives that we can point to. The dissonance between received, or let's say what the real economy outcomes for most people and household strains cannot be gainsaid. And I think that's the paradox that perhaps some of the policy conversation here will shed some light on. But all considered, if I leave aside the challenges on the fiscal side, it's very clear to us that even though still below optimal output, even at 5.1%, is trending in the right direction. And so as we close, I think it's important for us to bear in mind, this growth is actually across most sectors. I think more buttressed by agriculture has been pointed out. If you recall, bottom-up economic transformation agenda that was one key sector that they prioritized. So again, correlates to the inflation question, FX reserves, what have you. And what we see then going forward is services continue in this current resilience. There's no question that even at half year, you've seen 5% is achieved. So in short, we are very, very optimistic about 2026 for those reasons. Of course, we need faster growth. There could be risks that we can talk to in the panel, and we have a very able panel. I'm sure they'll dive into that. But I just needed to provide a slight nuance to what John has revealed our internal focus for 2026. So with that, I yield back the time. I think John has taken an urgent call. I'm trying to save up the time. So I'll proceed. Okay. Sorry. Okay. Could you ask John to come back in? Sorry. Okay, now I'm done. Oh, okay. This is a medical emergency, understand? So why don't we? Yeah, sorry. Please come back. Come back. Thank you. Sorry.
Yeah. So thank you, Rafa, for that. For those who don't know, I'd seen the presentation, so don't think I missed anything. It's walked me through it quite a bit. So as we have discussed here before, this platform brings together policymakers and the private sector with the hope of informing boardroom discussions to catalyze the country's growth agenda. In interaction with some of you, we have learned that of even greater concern to business enterprises and policymakers is how to establish the pulse of the fiscal consumer beneath these headline GDP numbers in a timely manner. As we all know, given the complexity of national income accounting, official leading economic indicators are published with a lag. Our data architecture thus continues to lag a high-frequency indicator of private final consumption, which accounts for over 70% of GDP, even in this age of massive digitalization and e-commerce. And this is important because often we talk about the numbers and then we have to go run surveys for the individual consumers. Obviously, we get feedback from consumers. I think there are quite a few surveys that have been published about consumer experience. And so here at NCBA, we've decided to close the gap in a country's data architecture. We believe that developing a high-frequency consumer activity indicator will be helpful. The same way you get statistics from the Bureau of Statistics pretty much every month, that statistic does not necessarily speak to consumer behavior. And when it does, it speaks from surveys which cannot be done on a monthly basis. So ladies and gentlemen, as NCBA, we continue to live true to a vision, which is to be the financial partner to inspire your growth. So in full realization of this vision, I am pleased to announce that to address some of the gaps in our data architecture as a country, we will be unveiling the NCBA Consumer Activity Index. This is the first of its kind in this market. The novelty of the NCBA Consumer Activity Index is that it will not be a survey, but will seek to capture revealed consumer preferences by analyzing actual consumption patterns, rather than relying on stated intentions, which is what surveys do, or survey-based expectations. This anchors the proposed index as a credible measure of actual consumer spending behavior. We believe that private sector enterprises and policymakers will find this regular analysis of the trend and level of consumer spending very, very helpful. And moreover, the index will prove quite beneficial in product development. We'll not be unveiling it now. The hope is that we'll unveil it in January. We have developed it. It's proper data-based observed data. That's what it is. I was speaking to the economists at NCBA when we were developing this, and I was telling them in my days on Wall Street, we had lots of indicators, including, I'm sure Mr. Owino knows this, how many underwears were being sold. Gave a certain indication, yeah? And so you tracked all these things, and every week you would look at this data. And they used to say if more men underwears are being sold, that meant the economy was to be very good for some reason. If more women underwears were being sold, the economy was to be bad. You know, those were some of the observations we were making. So it's coming up with an index that follows actual consumer spend. So please do look forward to that unveiling that we shall do in January. So as I conclude, I wish to reiterate that through our various thought leadership platforms, we will continue to bring to you innovative research output, as well as the best brains in our country and beyond, to outline what we need to do to promote economic growth and resilience. The important work of building our country is an investment worth making, and one that we as NCBA always stand ready to support. So ladies and gentlemen, thank you again. And before I call our next speaker, let me ask our panel to be patient with me, that we go through the keynote address, and then the panel can react to that keynote address. I know we'll be running a bit later than we had promised, but I really do beg for your patience. So it's now my great esteemed pleasure to call our speaker for today, a keynote speaker for today, a man that needs very little introduction. If you're on X or Twitter, he needs different introduction from there. But in this room, we know him as one of the greatest economists of our time, according to the Telegraph. A man who not only is well educated, but he has taught well. He has taught well to us on economics. A friend of mine for many, many years, and one who is now the chairperson on the president of the President's Council of Economic Advisors, Dr. David Ndii. Welcome, Dr. Ndii.
Good morning. No, I think I'll be fine, as you can see. Good morning, NCBA executive, business leaders, panelists, who are all my good friends. Allow me also to ride on protocols already established. I'm learning that language. It is not my, it is not my area. But having said that, let me thank NCBA for this forum, as has been said by my good friend Raphael. In these days of disinformation, I think platforms like these are very important and very rare, because the amount of disinformation out there on social media and everywhere, and the amount of noise. So the noise to signal ratio is very high. This kind of safe space allows us to actually speak to issues without all that noise, and really appreciate that NCBA is so gracious in organizing this forum and inviting us every year. Let me acknowledge my colleague, Mohammed Hassan, and everyone. So I believe that I don't have to go over old ground, because we are now, I think has been said, on matters stabilization of the economy. That's what we have discussed over the last two years. And so I have titled my comments within the context of the theme of the event as moving from stabilization to sustainability. How do we sustain? Yeah, how do we sustain that stability? I like to compare macroeconomic stability to good health. You see, if you're in good health, you take it for granted. Yeah, it is when you are in the hospital bed that you really realize how important good health is. So we Kenyans are very spoiled, because we've been reasonably stable all the time. It is countries which have had bouts of hyperinflation that really know how economic stability is important. So if you ask Argentinians, the premium they put on stability, that's what you're seeing in their politics. They are prepared to go kitchen sink on social spending and all the other important things, so that they can restore stability. If you ask Zimbabweans, they will also tell you that hyperinflation is something you don't want. But I think because we've been reasonably stable, we have taken it for granted. The few episodes of turbulence we have had have obviously, I hope they have taught us that that is a route we don't want to go. Hence, my point, how do we first of all sustain that sustainability? So that's why I thought that that's important. Let me make some observations around just respond very quickly to issues of the global environment. Yes, as I agree with Raphael, that paradoxically, on the one hand, you have the policy turbulence around Trump tariffs, but the other hand, you have very aggressive monetary easing, rate cuts, which will obviously work for us. So there is a bit of balance there. But the other thing is that we obviously have a bit of exposure, but most of our exposure to the Trump tariffs is largely around the apparel sector, which is important. But we think that we can ride that out. We are very aggressively working on how to diversify. We have two diversification strategies. You'll be aware we have signed an EPA with Europe. We don't sell much apparel to Europe now, but we do think because of the EPA and what's happening to some of our competitors in Europe, like Bangladesh. Bangladesh has been a least developed country. It is now caught up with us, GDP per capita. It's now going to be a low and middle income country. That means it will move into tariffs in Europe, while because we have a EPA, we have free market access. Europe, obviously, we have to recalibrate our apparel industry because Europe requires different products. But that's one area. The other area we actually see opportunity in apparel, surprisingly, is Africa. Because a lot of these apparel we sell to the West. You see people, Africans, going to buy the same apparel and taking to their countries. So now you got to look and ask, with the Africa Free Trade Area, why can't we actually sell directly to Africans and cut the middlemen? So we are working around that. On inflation, what has been mentioned, but I'll speak to that a bit later. On debt vulnerability, again, there was a mention of very aggressive of our liability management operations. I think we have reduced that vulnerability quite a bit of external debt by various measures, the last of which I sort of just mentioned in passing, it's been spoken, was the conversion of our Chinese SGR debt from USD to RMB. And that reduces our exposure again to dollar. It was also a significant issue around multilateral financing because there was a sort of issue being raised by a legitimate issue by other lenders that they are lending you money and you are paying China. So, and obviously lenders don't like to do that. So we've kind of handled that. That was the main reason for handling that, and that I think is a bit out of the way. So just with those comments, I said I think we can, I would not sort of go too much over the territory around the stabilization. I'll just show where we are and what we need to do to sustain. To sustain the stability, because that's the precondition for growth. Shocks are very bad for your long term. So are we able to build in the resilience so that we can now focus on our better agenda, and which is inclusive growth and jobs. So that's basically what I'm going to speak to. If you can sort of flip the slide. So that's just a summary of what Raphael said about, you can see all those three key indicators, inflation, interest, and exchange rate. You can see the point at which they all turned. I don't need to speak to the interest rate and exchange rate. I'll speak to the exchange rate question very briefly on the matter of, it's almost anticipated. Is it too stable? I will make a comment on that. No, just stay there. Stay there a little bit. The one I want to speak to briefly is on inflation. You can see an upturn of inflation. I think there's been mentioned about food price vulnerability. You can see a bit of upturn around food prices. Now, the paradoxical thing about why you are seeing an upturn pressure on food prices is actually a good thing. Why is it a good thing? It is a good thing because it's a demand side issue. And we saw this many years ago after the coming in of the NAC administration. The people who took the biggest hit from inflation is the lowest income groups, who spend a lot of their money on food. So if you have to spend most of your money on unga and on basics, you don't have money to spend on other things. So when those people's disposable income improves because of more stable prices of basics, what do they consume? they actually buy more food. Yeah, they actually buy more food. And what you'll see them doing is buying things that they could not afford before, or more of things that they could afford very little. So you see pressure on animal protein, you see pressure on fresh produce, because they're now not having to spend everything on unga. So if you look at the things which are really very, a lot of pressure is fresh produce and meat. And that tells you probably people at the very bottom are doing a little better. The other thing, of course, it means that it takes up time for supply response. And that's why you see the most volatile elements of food prices. If you go in there, take the CPI report that KNBS publishes, look at what keeps consistent the prices, the stubborn prices. It is fruits, vegetables, and meat. Now, for the people in this room, that is not a big deal because you can afford it any time. For the people at the bottom, those are luxuries they could not afford when unga was 200 shillings. Now, because a gorgoro of maize is 120 shillings, the extra 80 shillings goes to fruits, meat, vegetables. That's what happens at the very bottom. That's why sometimes we miss. There are huge distribution or dimensions. You can turn the thing around and see, imagine now what pressure when you have very high food prices on the basic staples, what pressure that puts on people at the bottom in terms even of nutrition, of basic nutrition. So obviously that means that we also need to do a lot of work to improve supply side of those things. It's an economic opportunity as well, because then that means that those farmers who produce those particular things, you will see them benefiting a lot from that change. And you will see some of that fairly shortly. I think we can move on from there. The next point I make, I don't know whether you'll be able to read that, is the question that was posed by Raphael and by everyone. Is the shilling too stable? Now, this slide is very old. It is from an article I wrote in 2019 or 18 in response to the issue, the same issue there was a tiff between Governor Njoroge and the IMF as to whether the central bank was defending the shilling too much. And you can see the top panel is from an IMF report. You have a very flat nominal exchange rate, which is very stable, but the real exchange rate is appreciating. So at the time, the IMF was saying that you are preventing the shilling from weakening. Now, at this time, if you look at the chart now, which is not here, which looks exactly the same, now you have too much stability, which is preventing the shilling from strengthening. So you ask, which is which? If it is too stable, it is preventing it from weakening at some point. So which direction should it move? The truth of the matter, nobody knows. And the point that I am making here, I was then able to demonstrate with the panel at the bottom that if you look since we liberalized the shilling, there's been a gradual kind of weakening of the nominal exchange rate. That's a nominal exchange rate index, which is weighted exchange with all your trading partners. They are trade weighted. That's what makes the difference, an index of trade weighted. But on the whole, there is a very steady appreciation of the real exchange rate. So the question is, you cannot tell, is it the government that is responsible for that? It is not policy driven. There must be other fundamentals which are driving healing. I think I can see some people who've been to economics class. If anybody who's been an intermediate macro class may have come across the exchange rate overshooting model by the late Rodiger Downbush, which tells you that the exchange rate has a habit of moving very far away from equilibrium. It's not an equilibrium variable. It is hardly ever at some equilibrium because it has two things going on. It has the financial side, which you people deal with, which responds very quickly to various stimulus. And then there is the real economy side of output and employment, which responds very slowly. So the real exchange rate is a concept around the real side of the economy, which is factor movements. But the things which move very quickly are the financial side in response to uncovered interest parity. I won't go into the details. So a lot of these debate and the IMF asking whether it is moved too stable, too unstable, is basically witchcraft. This is just witchcraft we economists do, which can go this way, can go this way. But the policymaker has to be pragmatic. The policymaker is asking, what do I want to see today? Do I want to see huge swings in the exchange rate? Because it overshoot. If you think about the graph we had before, don't have to go there. Remember it overshooting because of people pricing default. And it went all the way to 160, could have gone to 200. Yeah. That's what economics calls sunspot equilibrium, sunspot phenomena. Now, do you want it to overshoot completely the other way around and it goes down to 100 or 90? So as a policymaker, you have to be pragmatic. And the truth is there's no model we can tell you, econometric model, which can, maybe AI models will do that at some point. But right now, the only tool you have is common sense, to be honest. Anybody who's telling you that they have a model which beats your common sense is just doing witchcraft. That's my end of that issue. So I think the more important indicator which tells us about the stability, whether we have what we have done in terms of stability, is this one. If you look at the Eurobond that we just did in September, that is the lowest spreads at issue that we have had since we debuted in the Eurobond market in 2014. Yeah, it was a 7-year at 3, the spread is what? I can't see the numbers very well from here, but it's 300 and something basis points. So if you think about what that tells us, when we issued the Eurobond in 2014, when interest rates were very low, and we issued at 6.275 and a number like 7.25, but the US interest rates were like 2, below 2. So if the US interest rates were what they were then today, yeah, the treasury bond yields, we would be issuing at a number around 5, 5.5. So that's why your spreads tell you better about the risk premium that the market is asking, the sovereign risk premium. And this is the lowest I think we have witnessed in. So if you ask me which is the correct verdict, the correct verdict is not the witchcraft of economists, but the wisdom of the market. The wisdom of the market is telling you whatever you are doing, keep doing it. Yeah. So, and that's why I say market discipline for me is a more important thing to pay attention to than some macroeconomic sort of program framework of the IMF or anybody else. If the market is giving you a thumbs up, keep going in that direction. That the market is giving you a thumb. What about anybody else? And we have this disconnect because when the market people come to talk to us, we hear a totally different language from when the IMF and the Treasury are talking about. But that's so we. I think there's a big question there. So that's the end of that story. on stability for now. The thing that I want to ask is what has been driving, what's underpinning this stability? What has gotten us here so that we can keep doing it? So I have a list there. Next slide. I have a list there of the things we think we have done that have contributed to this. And you see, I start with agriculture. One of the challenges you have with the people like the IMF and people who are seeding, they are purely demand side people. They have no view of the supply side of the economy. So the fact that our inflation is predominantly supply side is not something. So even if your inflation is being caused by food pressure on prices, the IMF will tell you to raise interest rates. Because there are those people who are saying when you have a hammer, everything looks like a nail. But the main intervention that actually has helped us is agricultural production and productivity interventions, the input subsidy program, helping to improve. I'll show you some things on expanding irrigation around rice production and some market development interventions in various crops, which are in our plan. That was our plan. The way to, if you look at the plan, our first intervention, our first target, we don't talk about inflation, we talk about cost of living. It's the same thing. But cost of living speaks to real things. Inflation, the same thing. But when you call it cost of living, it actually means, sort of speaks more to the micro side of the economy. Just stay there, I think, or it's just falling out. The other one is, of course, the foreign exchange side of things, which you're familiar with, the monetary policy. You have to do that to stay with ahead of the curve, or to actually catch up with the curve of the global interest rates, the petroleum G2G transaction, which helped us to unify the rates from the shortage, the debt liability management things that we've been doing. We have also benefited a lot from remittances. And this is an unintended consequence. We did not set out to intervene in the labor mobility space so that we can actually increase remittances. We set out to intervene in that space to address some governance challenges in that space, very chaotic, including human trafficking. So we have rescued Kenyans from Myanmar, some place where they were in some, what do you call them, sweatshops, some slave labor sweatshops in the middle of the jungle, doing gambling scams. We sent 2 plane loads to Beirut to bring people we didn't know were there. So we were really intervening to deal with the distress that Kenyans were having in Saudi Arabia, domestic workers. But the consequences by doing so and formalizing that space, has made it much easier for those Kenyans to go and work formally now in the structured manner, where you have bilateral labor agreements and all of that. And the number we have since we came into office until about a couple of months ago was about 400,000 people. Some would not have gone. Many of them would have been trafficked. But now they are able, our embassies in those countries know where they are, who they are working for, and it's a fairly sort of structured program. So that has helped us a lot in you can see the growth in remittances. And then there are some policy reforms which I will show shortly around things like coffee, but just highlights of those things. So those are the things we think are important. The next question is how do we take them forward? Because they are also the things which you need to deepen in order to then move towards sustainability. Move on. Next slide. I don't know how well we'll be able to see this. It's not too much. The things I have highlighted there is 2 things just to illustrate. If the round thing at the bottom shows what has happened in the dairy industry, for example, when I was talking about demand. We came in when the value of production, milk production in the dairy was in the about 30 billion shillings. Last year it was 60, it has doubled. This year we think it will be more like 75. It's huge production increase. The other one there is rice. I mentioned it. You can see an increase from about 200,000 metric tons of paddy to 280,000 metric tons. There's still a bit of a huge runway there because we're consuming about 1 million metric tons of rice a year. We think we can do a lot of import substitution. We don't have enough land to go perhaps no more than halfway. We can get to 500,000 metric tons, but that means a lot for the farmers who are producing it. But we will still be importing about 50% of the rice we consume, no matter what you do. So even when you hear people making noise that we are importing rice and allowing imports of rice, we cannot meet our demand for rice from domestic. Our population is growing too fast. We don't have the consumption. We don't have enough land. We are unless we invest heavily in irrigation in the middle of wherever. And I'm not sure rice would be the first choice of crop depending on the cost of irrigation. There are some things we just have to be importing. But just some illustrations of the agricultural production, things that are now sort of helping drive. Go on. Next slide. And you can see the impact there quite directly. 2023, we imported, as I said, 940,000 metric tons of rice. Last year, 24 is the first time that our rice imports actually fell. Not by much, but to 900,000. Maize, you can see 2022, we imported 800,000 metric tons. By last year, that was down to half. So if you think about the payoff in terms of foreign exchange saved from those food imports, then you have there sugar, 644,000 metric tons to 340. If you add up that in money terms, it is a fair amount of foreign exchange saved and income to farmers. And also because the food you're importing is very expensive. Remember where the exchange rate was. Yeah, remember where the exchange rate was. And then there was also a commodity price spike globally. So if you add those two effects, the impact on consumers was quite heavy. So now you are able to produce domestically and the exchange rate has stabilized. So you can start feeding through into both inflation and also in terms of your foreign exchange savings. So these things, you can actually trace them. They are actually trackable. I just want to say, you can see the actual numbers underpinning what we are talking about. And those are actual quantities. Next slide. The first panel, I don't know how many of you play in the coffee space, but we've done a lot of things. We've tried to do this for 20 years. When I started working on coffee, potential reforms, 20-some market reforms, 20-something years ago. It's taken me getting into government for us to do the things that we wanted to do that should be done 20 years ago, which is basically dismantle the coffee cartel. I know some of them are business people, but honestly, that needed to be done. And the way to do this, the most impactful reform there is a thing called the direct settlement system, which means that you separate and then breaking up the vertical integration of coffee dealers and the coffee traders from milling, marketing, export, all sorts of things. So you have to choose one thing. So the impact that you have seen there is if you looked at a couple before 3 years ago, and you looked at the coffee auction, 20% of the coffee would be a high grade, what they call Kenya AA, AA and AB, one, and 80% would be lower grades. If you look at it today, it's 80% high grades and 20% low grades. The quality of coffee hasn't changed. Something else has changed. So farmers, you're now there's a price discovery. There's a price discovery thing which is happening. Of course, the markets, farmers are also getting, we also fixed all the fees that service providers can charge coffee to a maximum of 20%. So farmers get 80% of the final price. And then you are doing this by direct settlement. The impact of that, you can see this year, half year. In last year, we sold 36, exported 39 million metric tons of coffee, 39,000 metric tons of coffee. Half year this year, we have done 36. So we've done almost 90% of last year. And you look at the price has gone up from about 5 export price unit value, $5 to $7 per metric ton. That means if you're a good coffee farmer doing 10 to 15 kg per bush of coffee, and you're going to be making a grossing about 1 million shillings an acre. 1 million to 1.2 million shillings an acre. That's the sort of incentive. Here I'm telling people that don't plant now. The amount of coffee being planted right now is phenomenal. And by the way, the maturity has come down. There are some new varieties which are doing it in 3 years. And the places we also were seeing is expansion in non-traditional areas. Rift Valley, a lot of Rift Valley, Kitale, those sort of places. There are even now an initiative to grow some Robusta in Lower Nyanza and Kwale. So I think coffee is going to be a big story for a while. My own forecast is that you're going to see the quantity doubling by end of next year. We've been doing about 40,000 metric tons. I think we will do to double that by end of next year, and probably double again in another 2 years. So I see coffee actually catching up with tea. It used to be more than tea in terms of our export earnings. In about 3 years, I think coffee, we've been doing 200, because we did 200, about 290 million metric USD last year. We've already done 260 million by half year. So this year you're looking at maybe $400 million plus. And I think in another 3 years, I wouldn't be surprised if coffee hits $1 billion of exports. The other panel is showing that the milk story is still continuing. You can see the first half of the year, the output, that is the milk sort of delivered to processors. The number is going up, and you will see why shortly. Yeah, so those are the sort of market reforms. We've also done a fair amount of market reforms in the dairy sector, but we still have quite a bit of work to do there. So what do we need to sustain this? Our imperatives for sustainability is, number one, fiscal consolidation. That has to continue. Elections or no elections. Okay, that has to continue. I think there is a sufficient appreciation of that. I think that little turbulence has sent a bit of a message that I don't think anybody in the administration wants to go back where we started. Nobody wants to go back where we started. So I think there is sufficient appreciation that fiscal discipline is critical. We need to expand our revenue base. That remains our plan. It's moving. It is sort of moving. So it's structural, but we know what to do. We just need to get it off the ground. It's a lot of technical work. You also have to move institutions with you, carry institutions with you, and that's not easy, but we're doing it. We also have quite a lot of expenditure and finance side, not just revenue. You mentioned expenditure. There's something I'm going to speak to briefly. We're calling a new service delivery model. It's familiar, but we're now kind of formalizing it into a major initiative. There is a state-owned enterprise reform agenda. That GOE bill, which is before Parliament, is to convert our enterprises into companies limited by under the Companies Act, from the State Corporations Act, and we move these companies to LLCs, many of them. And once they move into LLCs, they are now improve their governance. We want to delink them with ministries, policies, and look at and have them managed as a portfolio of investments, so that you can maximize. The mandate changes from policy to returns. Yeah, for quite a number of them. And there's a link to that, to the third thing called the National Infrastructure Fund. The purpose of the National Infrastructure Fund, I'll show briefly, is to deal with, I'll tell you why it is to scale up infrastructure investment, but off budget. That's how you deal with some of the trade-offs. What can you do on budget and what can you do? What drove us into the kind of fiscal crisis that was then hit by COVID is that we started out when we saw a lot of cheap money out there. After the whatever, and we were able to go to the market, we said it's a good opportunity for us to get cheap financing and build a lot of infrastructure. Unfortunately, we didn't think that the party would end. In fact, nobody saw COVID coming. So by the time the party ended, we were caught out in whatever, and then the rates went up. And of course, a lot of the infrastructure you had done is fairly long term, railway, stuff like that. And so we said, now, what do we learn from that experience? We learned from that experience, and also that briefly, is that you want to limit the thing. If you look at your deficit, is about half of it, 2 percentage points of GDP, is this heavy capex infrastructure. And a lot of it is commercial. So we borrow money from the World Bank to on lend to KenGen to do power plants. KenGen is a commercial enterprise. KenGen should not be on budget. Yeah? KenGen should go to the market, and that fiscal space where we can get cheap concessional money should go to education and other social investments. So that's the idea, and also that briefly. Then the sustaining agricultural productivity, growth, and resilience. Agriculture is still going to be a big thing for us to sustain. Agriculture is still our production base. And anybody who tells you that we should focus on industrialization, tells you Southeast Asian stories, I tell them that's a monkey DC, monkey do story. You need to understand your own economy. We do not have sweatshop labor. So we cannot do the Bangladesh or the sort of original sort of cheap labor export land industrialization model. We don't have the same factor endowments. So if we have to industrialize another way. And our industrial base, our production base is agriculture. So even if you look at our manufacturing, half of it is agro-processing. So the way you can be competitive is by building on what you are competitive, not at looking at what other people have done. You can do a bit of that and you'll see quite a bit of it, but it certainly is not at this point likely to be the kind of engine that you see in the countries whose abundant factor endowment is cheap labor. We don't have cheap labor. And then the next thing that you think we need to be able now to kick in is investment. And that is the end of my presentation. The rest are just pictures to demonstrate what I am saying. So let's move on. So this is our revenue expansion story. As I said, we actually know where the revenue is. We think we've done analysis which shows us that our revenue gap as of now, based on the current baseline, is about 8% of GDP, the revenue we can actually collect by expanding. I showed some of the analysis, for example, in the personal income tax last time, but this is the whole picture. You can see those are percentages of GDP, VAT tax yield gap of 2.89% of GDP, personal income tax, 2.7% of GDP, domestic excise. We have actually mapped and we know where this is. These percentages, if you look at in terms of the tax itself, how much you're collecting for personal income tax, other than payroll, because the people in payroll are the only ones who pay personal income tax. The people not on payroll. The actual gap on the people on payroll are not on payroll, are paying 2% of what they should pay. So we are not collecting 98% of income tax of the people who are not on payroll. So the people we are overtaxing is one sector, the payroll workers and their employers. Because We tax the employers' corporate income tax, and we tax the workers. So it's a lazy tax collection. And that's why I'm saying we have to carry our institutions with us, because we have to tell them, you have to get out of this idea that you squeeze more money out of the people who are already paying tax. We were actually doing that exercise yesterday, doing some simulation yesterday, validating that because we are now able to estimate people's, virtually every Kenyan's potential income. We have using AI models and lots of big data. We have some work we're doing to stimulate. And we're actually able to validate that the people who are not paying tax, I think, let me see what the numbers we arrived at. Out of the 17 million people on non-payroll, about 20% are actually taxpayers. They're in the tax bracket. The vast majority are not, but that 20% is about 2.5 million taxpayers. And those two, that's more than the private sector employees today. And those people, the average tax potential they should be paying is about 200,000 shillings a year. So there's the same number. So then our number works out that the people not on payroll should be paying the same amount of income tax as the people on payroll, about 600 billion shillings. So there's a potential to double that tax there. And we've done the same analysis for VAT. There are things we want to do which are very radical on the VTA side. Customs is quite easy to do. You just take mirror data. What has China declared it has exported to Kenya? What has Kenya declared it has received from China? And the gap is about 40 to 50%. Understatement, all sorts of things. You do that for your 3-4 big sources of imports. And that's not a very big, difficult thing to do. It is about integration of customs systems, but you see that there's a lot of foot dragging there. So but we do know that the things we need to do. The National Infrastructure Fund, why I said it's important, if you look at it, the orange thing shows you it is in our manifesto. When we were talking about how do we finance the plan, we said we are financing plan in the context of fiscal consolidation. That's something we recognized even before we came to government. So if we're going to be able to finance infrastructure, the way to do it is to take it off budget. And our proposal was to take it off budget by capitalizing an infrastructure fund or bank using privatization proceeds. We would have done it 2 years ago had we been able to do privatization. But of course, the Gen Z and activists and all sorts of anti-privatization people, they went to court and stalled that. We've only been able to unlock privatization this year. So that is why this is becoming whatever now. Because we do intend, and we have the sign off by the president as soon as we get the proceeds from the privatization transaction, starting with Kenya Pipeline. We capitalize this infrastructure fund, and we leverage on it to bring in blended finance, to crowd in private capital. We have a target of 4 shillings for every 1 shilling we have, 5 times, and we crowd in that money. And then we also build our own project development and structured finance capacity so that we can expedite PPP transactions, so that we can use it also to have that capacity. Because we've discovered one of challenge why these private PPP transactions don't move is that the contracting authorities, the people who we tasked to do this, the state enterprises which own the project, don't actually have the capacity to do it. So the thing just sits there between them and the PPP committee and all sorts of people. So we think we should centralize that and actually have the capacity to drive these transactions, especially when you have skin in the game, because you are then able to de-risk the transaction and you also have whatever. So this is the mandate we've been given to do 3 sectors. Water and irrigation and agribusiness infrastructure. And the target is to irrigate 1 million acres. So again, it takes you back to something Gashora said, rain-fed agriculture. We cannot continue on that model. So, and that then reinforces the resilience that you're talking about. So that's one of the number one big thing is to drive that. Energy, that's you need for manufacturing and industrialization. Our target is 10,000 megawatts. It's a stretch goal. But you're not going to be able to attract much significant, and I'll show you some of the investors who are coming on 2,500 megawatts of power. Some of them need 500 on their own. So if your total is 2.5, you're really not in that business. Then transport infrastructure. We are looking at about 1,000 kilometers. I think it's a bit more of what we call a national highway. Kind of whatever, probably 2,000, yeah? Because by the time you put in Mombasa Road, we know some of them, Mombasa Road, the Namanga to Arusha, then the one to Meru, and that Mount Kenya circuit, Western Kenya, where we are doing the Mau Summit, maybe a ring around the lake, connection to Uganda. There is about 2,000 of highways we think we can fund off budget by PPP and tolling. There will be a lot of noise, but we are going to toll them because otherwise they will not be built. And then the money on budget can then build rural access roads. But if you then use all your money on budget for highways that can be paid for, then you won't build the rural roads for agriculture. So that's a trade-off Kenyans have to face. Do you want the rural roads? Okay. If you want the rural roads to your village, then you must pay for the highway. Or if you don't want to pay for the highway, then you stick without a rural road. Because we can't do both. So that's then of course the airport we have to do. You don't talk about the airport, it's very embarrassing. We have to complete SGR. People are asking, how are we going to fund SGR? Off budget. We are not putting more debt on exchequer. So if it's not bankable, it won't happen. That's the test we are putting all these projects. The reason we have put this fund, it is not investing directly in any project. It is co-investing. So the project that you invest, the way we're not putting debt on the balance sheet of the National Infrastructure Fund. The Infrastructure Fund will have a portfolio of investments. It's a fund manager. It will have a portfolio of investments on bankable projects where it's co-investing. So the test is that it has passed private sector bankability, then we can put money behind it. That way we don't make the old development finance mistake of having a rotten portfolio because you made political investment decisions. The upset, we are reconfiguring that. There's potential there for some infrastructure projects. That's what we are doing on the finance, on the reform side. I talked about a new service delivery model, and I say the way to do these things, because sometimes people say we are lying, is to actually show that it's happening now. Using the example of vaccination, there was a big hue and cry about where we want to vaccinate cattle, and people said we want to do some Bill Gates things and all sorts of things. But farmers always vaccinate cattle. We lose a huge amount of livestock to foot and mouth disease, as well as market, because of phytosanitary requirements. You have outbreak of FNB, and your market say that they have suspended sort of products from your country. Just go back to Dogo. So go back one slide. It's important. So what we are doing, we then have said, look, we've got this model we're using in fertilizer where we send the voucher to the farmer and we onboard a supplier and they do business off budget. The old model is government want to deliver service or subsidize something to farmer, government procures and then distributes. Yeah. Now, if government procures and distributes through chiefs and various other people, you know the story. So what we're doing is we say, no, we send the benefits to the money to the beneficiary by way of a voucher. We then onboard suppliers. Tell them when the beneficiary pays their part, we will pay our part. And we're leveraging on technology because we don't control the technology. It is sitting with telcos. So telcos, give them the money in an escrow, they convert it to vouchers, tell you when the farmer pays their 2.5, we will pay the supplier our 2.5. So we've done the same with vaccination, and we don't actually need to charge farmers, but it's important for them to pay something as a control. So the farmers pay 50 bob, and then that activates the voucher. That means we have onboarded the vaccine provider, who is a government entity, and also onboarded the vets who will do vaccinations, the ones in the village. What we were doing before is the people in headquarters would procure, then they would all get onto a caravan, and then they say, we have gone to vaccinate cattle in Isiolo, and then they come back after a week. 80% of the money went into per diems. And you can't even trace the cattle that were vaccinated. So now, what we have done is we have now put this on the platform. We send a voucher to the people, and you can see all the counties are rolling it out. That way, we have a program that we can now assure that we can actually vaccinate all our livestock against foot and mouth in the next 3 years, and probably become a foot and mouth free country. That has huge benefits, and we won't spend that much money. I think the total budget is about $75 million. That would not have probably done even a quarter. Now, this thing here looks very mundane, and this is technology, not technology, it's an intervention to commercialize fodder production. It's amazing that given the amount of livestock we have, and how important livestock economy is, we don't have a commercial animal feed kind, especially fodder kind. So that way we have a 40% to 6% production deficit. So what we're doing here is having one set of farmers produce fodder for the other set of farmers commercially, and then putting it in a market. So that there's a national market, so that silage grown in Uasin Gishu can actually end up in Machakos. That way you liberate at a cost-effective rate. So that's sort of a silage being produced somewhere in the Rift Valley. And what you see there is a market where somebody has come to buy the silage for their cattle. That thing weighs 60 kg. It costs about 400 shillings. It's actually a very cost-effective way for dairy. That will mean you're producing milk at about 20 shillings a liter. And then the one at the end is the same grass being grown actually in Mandera for the pastoralist cattle. We have got about, potentially, our target is to do 1 million acres of commercial fodder to then boost, because we think livestock is actually, we've done a lot of crops. What we think is the next stage for agriculture is livestock, crossing the nutrition. Finally, I talked about investment. Just highlight what's happening. I think I was just telling Ashora, what you might not have a view of in your growth projection is the investment pipeline. I think it's a good place to start with agriculture. That's a new animal feed factory. It's actually opened a few weeks ago. It belongs to a Dutch company, one of the biggest animal feed producers in the world. It's in Athi River. That is already started. And you can see it's a response to the people who understand agriculture. They're hearing where we are going. So they have decided there's going to be a big market for animal feed, and they are setting up shop that's already up and running. The next set, I don't know how many of you followed this thing. A couple of weeks ago, we launched an SEZ in Kilifi. It's a joint venture between Centam and Arise Vipingo, 2,500. The expected investments there is about $3 billion. You can see some people signing. They are one of some of the anchor investors is Arise themselves. They are building a huge textile plant. There's a Chinese equipment manufacturer company called Sunny. They're setting up a sort of earth-moving equipment plant there. Foxconn, the Taiwanese sort of mobile phone people, some component factory there. But there's the biggest one is a Chinese tire manufacturing company called Linglong. They're setting up their own SEZ. I think they promised to break ground in May. We're giving them land in Mariakani. They're going to bring in a tire manufacturing plant together with their own sort of ecosystem of suppliers. Their own factory is about $800 million. Their suppliers, the total investment in the next 4 or 5 years, about $2 billion. The electricity requirement there is about 200 megawatts. So you can't afford to and that's already happening. They do a lot of white label tires. They are the 4th or 5th largest tire manufacturing company in the world. This is part of the Trump tariff harvest of Chinese companies diversifying their supply chain. That company is moving, I think it's doing a plant in 4 of the continents, 1 in Europe, 1 in Latin America, and 1 in Africa, which they've chosen Kenya, so that they can be diversified. This is BPO sector, another sector we are seeing a huge upsurge in investment. I got that is a thing in, I got those images from Moria. That is actually the building where Teleperformance, they bought out a small company and they've expanded quite a bit to 5,000 seats. And that building there is going to house about 40,000 seats of BPO and service companies. I think it's development. So that's a space we are seeing a huge movement with the people in that area. That tells you what the people are seeing in Kenya in terms of BPO, why it's attractive. The people in that space are telling us, if you do a few things right, you're looking at a potential of 500,000 jobs in the next 5 years or so. Because the market is really opening for us in that space. So that's where we see the key drivers of investment. On the manufacturing side, most of it is actually coming from that China-Trump tariff kind of thing. But there's also, if you look at the kind of things you talked about, a lot of them, you look at them, are looking at our agricultural base. I think another company which I saw there in Arise is a company which is doing bioethanol from cassava. So they've engaged about 500,000 cassava farmers in the coast. And that's to produce bioethanol for export. So you can see that sort of value chain, the supply chains that we are pushing are attracting investors. We're seeing quite a few of them interested, for example, in the sunflower value chain, because we are pushing it very hard to substitute palm oil imports. So there's quite a bit of the very, very specific. Dairy is a sector we expect, livestock in particular, both dairy and meat is an export I expect to be our leading export sector in the next decade. So for me, I think the runway I see is still in agriculture. And based on the things I have a view of, I think my forecast for GDP growth even for next year is a bit more optimistic than yours, if the macro situation remains. But that's obviously because of advantage of information. I think probably Hassan, who spends more time on the investment, commercial diplomacy and investment relation, probably has even a better view of all the ones. There's quite a lot of them around, also logistics, quite a few things around logistics. So, but we are optimistic that investment is now going to kick in between our own infrastructure investment to support the economy, and now the response from the investor side. We think that in another year, maybe not next year, but we hope that from the year after, the growth we will see will be investment-led, but investment in productive sector, in the production sector, not public debt driven investment as we've done before, but actually bringing in investment that can actually begin even to sweat some of the infrastructure that we have built. So thank you very much. So do I come down or do you? Oh. So
thank you very much. Let's give Dr. David D another round of applause. I want us to have a quick photo shoot. So let me welcome John Gashora on stage. Raphael Agung, please come. Just come on stage. Raphael, please come. chairs. Come on stage, please. Could I have a tablet or something? Mr. James Gossip, please join us on stage as well. They need someone to speak. Gentlemen, just take a step to your left, please. A step to your left, to your left. Thank you, thank you, thank you very much. Camera crew, let me know once we are good. Are we all right? Asanteni sana. Thank you very much. Thank you very much, gentlemen. You may resume your seats. That has been the presentation from the chairperson of the Council of Economic Advisors, Dr. David D. Always so insightful to give us some fodder to chew on. And I would like us to transition into our panel conversation. And because my time has been cannibalized, let me ask the team to help me set up this the stage quite quickly so that we jump into our conversation. Mic check 1 2. Mic check, sounds good. On the panel, as we tidy up our stage here, on the panel I have Dr. Bimal Kantaria, Chairman, Agriculture Sector Network, that is ASNET, and you've heard how agriculture is front and center of the policy focus going forward. Please join us on stage, and let's appreciate Dr. Bimal as he comes on stage. I also have Jasmine Chonzi, Regional Industry Manager at the International Finance Corporation. Let's give her a round of applause as she joins us on stage. Oh. Thank you very much. Dr. Ndi, at the end of this panel, I will ask you to come back because there's one bit which I was hoping you would touch on and you did not touch on. We had a very important outing in Washington, D.C. in October around the IMF program, as well as funding from the World Bank. If you could get an update on that, that would be equally important for our focused analysis on the outlook for the Kenyan economy. Asante sana. Thank you. You may join us on stage. I'll be here. You can be here. And I'd also like to have Mr. Kwame Wino, as Chief Executive Officer from the Institute of Economic Affairs. You can use whichever side, Kwame. Karibu sana. We shall make this pretty snappy because time is first spent and certainly we all have engagements beyond this. Let me start with Kwame on the extreme end. Immediate reactions to the presentation made by Dr. Ndi on, as Raphael rightly called it, the midterm review of the Kenya Kwanza administration.
All right. I mean, of course, as David reports it, it's very clear that, okay, let me say this. As David reported, it looks like a really, really positive story. And if you look at the macro numbers, it's difficult to disagree with them. I mean, with the numbers themselves. But perhaps we'll come to this when we discuss the exchange rate, which is a question that he did, right? Should we leave that for later? But in the meantime, I think that a 5% growth rate is impressive, but hardly enough for a country such as this. I mean, if you have a population growing at about 3 or that about, so basically we're going to have 2% real growth over time in incomes. So that's a first. The second thing that I'd like David to comment upon is you have said that farmers especially have sufficient, I mean, or rather, something is happening on the farming side, coffee and that. And based on that, those numbers, that's true. But I'd have wanted us to comment on why incomes have been flat, household incomes have been flat for like 5 years and a bit. So in that view, of course, it might have been the shock of COVID, but also other things in the economy. So I think, and perhaps this is cliche, but to say Kenya has structural problems that you've spoken about before, but it's clear to me that it's clear to me that it requires a little bit more than rejigs here and there. Shifting one thing here, shifting the other thing here. And then the third one is a question on taxation. I mean, you gave a good picture about 98% of, well, let's say that a small number of people bearing the burden of taxes, they're the same people who are here. I'm just wondering, David, whether, and I've had, not necessarily you, but the president speak about this, and so allow me to plug here. There's this claim that Kenya should aim for expenditure to GDP ratio of 25% and above. And if you look at the structure of households, jobs, and then coming down to the dependency ratios, I am not too sure that it's true anymore, that you can squeeze much more. Even if you leave the formal sector people who are here, that there's much juice to squeeze from household incomes on the other. I mean, with a poverty rate going to about 40% of the population, the amount of money you can squeeze, regardless of whether people have small sums or not, especially from direct income taxes or consumption taxes, is actually limited. And my view is one of the fixes that this government needs to adjust to is a moderate revenue to GDP ratio of expenditure. The idea that you're going to get 25, 27%, perhaps aiming for a little bit higher than that, is not realistic. And especially if you think about last year's generational protests, for me, the generational protests told me something, and someone like David, who's conscious of the political economy would know, is that my view about those generational protests is that they established a constraint, political economy constraint on how much taxes government can extract from people's incomes. So those are my 3 comments for the time.
Thank you for that, Kwame. The first thing is telling us is about the apparent dissonance we seem to have between the macros numbers and the micro realities that Kenyans are grappling with. The second one, and maybe a quick follow-up there, is when you talk about the tax to GDP ratio target should be moderate. If you look at the MTRS, it indicates 20%. What would be moderate for you?
All right. I see people cite the various figures, but whenever we at the Institute of Economic Affairs take what the average revenues reported by the KRA are, and taking the declaration by the National Bureau of Statistics of the output per year, it usually comes to a figure closer to about 15.5 and 16%. So my view is that it's not too far from where it should be. So that's one. 2, our view, including Bangladesh, which David alluded to, these are countries that are growing at a revenue ratio of 13%. So the idea that the fix is more government extracting greater revenues for growth to take place is something that I think, and my view is that yes, 20% should actually be okay. But I've had figures mentioned of about 25% and above, and looking at the dependency ratios, and even just the quality of jobs, right? So while people have jobs, they're not really permanent jobs that allow you to extract from. So yes, expanding taxes, revenue collections are possible by closing loopholes and tax administration questions, but the idea that we can aim in the immediate term for an additional 4 or 5% of GDP in taxes, in my view, would be not only difficult to execute, but is politically fraught with risks. I don't think this country can afford another 300,000 kids on the streets in Nairobi.
Thank you. Thank you, Kwame. Ma'am Chonzi, allow me just to call you Jess for this panel conversation. Formal financial inclusion, of course, quite key in terms of Kenya's outlook. What are you seeing as IFC? What do you think is being done could be done better around it?
So I think maybe just to start, I was just saying to Dr. Ndi that it's amazing that we are aligned in terms of what we see. We should be doing a lot more. I think the environment really presents an opportunity for us to do a lot more with the private sector, to grow and also just create jobs in general. So we do see Kenya's private sector showing really encouraging signs of revival. I think we're seeing a lot more willingness from banks as well as non-bank financial institutions and lenders to extend credit. And I think perhaps it's we're also seeing more demand from firms for more growth-oriented investment. So in terms of just a reaction to Dr. Ndi, I'm happy to stop there. Otherwise, I'm really happy to expand more what I think our alignment is on agriculture and infrastructure as a World Bank Group.
Thank you. Maybe let me jump on to Dr. Bimal at that point. I saw you nodding all along as Dr. Ndi gave his presentation, especially on agriculture. You are right on the ground, given what he's saying from the policy side. What are you seeing as a practitioner?
So, Bonadi, to be honest, for the very first time, I'm completely in line with you on agriculture. But you've been given a lucky one because rainfall have been excellent last 2 years. It's given you a little bit of breathing room. So some of the big numbers you're seeing is God-given. But it gives you an opportunity for the next 6 to 12 months to make the harder decisions. Bonadi, what is excellent, and I'm quite impressed, is you are taking the hard decisions. You've privatized the sugar industry. Excellent. It had to be done. I think the numbers will be that next year we might be even start exporting sugar from this country. So that was an excellent decision by government. You privatized Rivertex. Excellent. All these things you're doing in privatization, getting out of business as government, you've got 6 to 12 months to do some of these big decisions because I suspect next year's rainfall and then 27, the election cycle will limit your options. For the next 12 to 18 months, do all the hard stuff. Pull out of industry as much as you can, pull out of private sector as much as you can, do much more privatization. The second one I want to mention to you, David, is you've got to stabilize the taxation policy. Ask people on the ground, day-to-day business, every single budget, things change so much. I'll give an example on fertilizers. 3 years ago, it was 18. It went down to 0. It went to exempt. Now it's exempt. We just, every year, we can't run around every single day, things change. If you look at the fees that all the regulators are charging us, KEFIS is now charging us. We've got 6 new taxes in the last 12 months on exporters and agriculture sector. We've got to stabilize some of these fiscal charges. Just give us a level playing field like you've done with the macro economy, but on the ground, you've got to stabilize stuff that you're taxing us on. But David, to be honest, well done so far on the agriculture sector. I think government has done really wonderful stuff in terms of doing the hard stuff. But there's still a little bit left. And as I said, you've got 12 months to do it before the cycle changes. Thank you.
Thank you, Dr. Bimal, reminding us about, and when he talks about the 0 rating and exempt, of course, that comes to the VAT schedule, which is quite problematic in this market. Kwame, let me come back to you. And this is the second of last because of time. Tax-based expansion. You have seen it being flagged by Dr. Ndi. It is something we currently talk about. What are you seeing from an IAA perspective in terms of the number or the scope of the informal economy, as we like to call it, or the hard-to-tax economy that we can bring then into the net? And are we getting this game right?
All right. I mean, tax design is, okay, what the economics textbook tells you about tax design and how the tax administrators understand and how those who make policy do it are completely different. But I think if you think about the fact that we have 3 million or thereabouts of people who have payrolls, who are on a payroll and their employers, as David mentioned, it's very easy to see why you go for the lowest hanging fruit. It's very easy. I mean, someone can come to your office, slap a tax assessment on you, and if you have the money, you respond because they can keep you in court or they can threaten you, whatever else that it does. But if you're dealing with 12, 13 million other people who have smaller incomes and all that, and they can all disappear or are difficult to find, I think we need to be careful. One of the things beefs I have, and this is not a ventilating forum, I understand, but one of the problems I have with a country like Kenya is even people who advise or speak as if we are Germany, where every enterprise has a fixed address, everybody has a fixed address, and you can find them. So we have a tax authority that behaves, or rather, that has been encouraged to behave as if all sectors are formal, very highly formal, records are very available, and therefore they're easy to find. And that's okay. The incentive, therefore, is to squeeze those who have it. But if we ask ourselves that if you have, depending on what estimates you look at, 2 million, 3 million, sometimes as much as 4 million different small sector enterprises, and obviously you need to bring them into the tax bracket. What's the method to use? I don't think you'd use the same method as we have now. It would probably definitely have to be a different thing. And my view is it would probably have to be a tax that's equivalent to a lump sum, which is basically, but if you're depending on small enterprises keeping records and calculating on a month-by-month basis, all that, it becomes too complicated, and justifiably. I mean, among them would be people who do not want to, but most of them actually would not be able to deal with that level of intensity. Were you going to ask me to comment on the exchange rate? Because I know this is my last.
No. I'll come back to you on that one. But maybe a quick follow-up to what you're saying about taxation. And to be fair to the government, Kwame, we have turnover tax, 1.5% of gross turnover. If you look at the collections, abysmal. And the government will tell you businesses who are eligible are just not simply coming to register. To widen the tax base, we introduce e-teams to create visibility. We don't want it again. So can we have our cake and eat it?
Well, I think the point I'm trying to make is, and it's not flogging government or anybody, it's just to ask yourselves is, if you look at where do taxes come from? Taxes come from either consumption or people's transactions or wages. And if you have 3 million people you can flog every day and you know they still have to come back to work, it's easy to see why the incentives have conditioned the revenue collection service to behave as it does, and Parliament obviously, and the executive as well to do. Because what will you do? So the point I'm talking about is, if you go throughout the country, there are thousands of enterprises, and the nature of those enterprises is people discount their labor very heavily. They sit in for 8 hours so that they can have maybe 500 shillings of trade in the whole day, which is okay. I mean, they're still making a living, but you're asking that person to keep monthly records and then subtract 1.5% of it every month, and to keep those records so that you can verify them. They won't do it. They just won't. So why you have a turnover tax 1.5%? And yes, that's. I mean, you're grappling with having to catch too many such people at the same time. So I think a redesign about, if you want to expand the tax base, cannot be the same thinking that you have, where you can come to, say, all of us here, privileged as we are, sit in an office and somebody will ask you, I want to see your payroll. And on the basis of that, know whether you've been honest or whether you have not. So that's a point. That's a point. So we've had, this country has been on this treadmill of widening the tax base, and I hear sometimes people say it easily. It would have to be a fundamental redesign of the thought in Parliament, which comes out with these laws, the executive itself, and obviously in the tax administration. And it might have to be, how do you vaccinate people? You have somebody riding on, coming to a school, asking mothers to come together so so it cannot be the posh and serious one, which is, you will come to me when I call you. They won't.
Thank you, Kwame. Let me come to Jess. You had a point to make around the investment landscape and infrastructure as well, I think. Please go ahead.
So I think one of the key questions, or one of the aspects that demonstrates private sector growth, is what's happening on private sector credit. We are seeing that the credit is flowing, and I think what we're also trying to figure out is it trickling down and actually catalyzing inclusive growth? Because credit rebound really needs to reach the smaller firms, the MSMEs, the underserved sectors, and just the other regions that have remained, largely unserviced. So for IFC, we see this as an immense opportunity actually to mobilize private capital where it matters most, and to also drive widespread impact. So like I was highlighting, that two sectors really stand out for us. So we are currently focusing on agriculture and infrastructure. So when we look at agriculture, despite being the backbone of job creation and livelihoods, smallholder farmers, I'm sure a lot of you will agree with me that they are critical producers of Kenya's food, but they really remain chronically underfunded. And I think when we look at global numbers, this is really just around shy of 10% have access to commercial finance. This leaves millions and millions of farmers out of formal value chains. So to address this, IFC and its partners are prioritizing initiatives like AgriConnect. So what is AgriConnect? AgriConnect is it's a World Bank Group initiative really designed to transform smallholder agriculture to drive job creation and food security. And how are we going to do this? The idea really is to connect farmers to finance, but also technology and markets. The strategy needs to be holistic for it to make sense. So we need to invest in infrastructure. We also need to be part of shaping business-friendly policies that allow expansion or access to digital platforms and commercial capital. And also we need to enable, bring in cutting-edge technology to farmers. So with AgriConnect, the target is ambitious, I must say. We're looking to connect 250 million smallholder farmers globally. But also alongside it, we're looking to catalyze billions in private climate-focused finance. So what does this mean for Kenya? It basically means we need to start working on modernizing value chains, boosting productivity, to create the much needed jobs that we're looking at, and also to help to feed our growing population, all the while trying to protect nature. So I'll just briefly touch on the infrastructure part. So, I mean, as we all know, reliable infrastructure is foundational for enterprise development. So if you don't have electricity, you don't have jobs, you will not be able to scale. We do have what we are calling Mission 300 platform, which we are looking to connect 300 million people to reliable electricity by 2030. It's aggressive, it's daunting, but in Africa, 29 countries, including Kenya, I must say, have announced M300 compacts, really strategic plans aligning infrastructure investments, finance, and policy reforms to crowd in private capital. And we're already starting to see, the much needed results by expanding access and building resilience. And we hopefully will see, businesses thrive on the back of conducive infrastructure.
So shall we presume that both on the Agri and AgriConnect and the infra side, you are approaching it via blended finance, or how does it work?
So because we're creating in a number of partners, we do bring in both commercial and blended finance to the table. But also some of these spaces have not been, growing as much, maybe like, the renewable energy space or distributed renewable energy space, where maybe financiers don't really have enough credit appetite. So we're coming in there with de-risking instruments. We've recently introduced, catalytic first loss facilities to try and encourage lenders to, take up a bit more risk on those spaces. So we are trying to bring in both the funding, commercial, and as well as blended finance, as well as technical assistance to support the efforts.
Thank you, Bimal. She's touched on smallholder farmers and the need to strengthen value chains. I know you mentioned you're a large player in the export side, but how are you seeing the small-scale farmer play here?
So again, David, your second part about sustainability is going to be the key in this one. The average farmer in this country, as you know, is 60 years old. Youngsters are not going to go into the shamba itself. What we are advocating now is agribusiness, and exactly what government is proposing. Agribusiness, value addition. I don't think we can ever go back to feeding ourselves 100%. The land is too expensive, input costs are too high. The young person doesn't want to stay in agriculture. So there's definitely a fundamental shift away from agriculture farming itself. We've been very lucky. As I said, the rainfall has been good. The fertilizer program has been very effective. Some of the stuff the government is doing right now, privatization, is really on the right track, but is it sustainable? So our view is private sector is, one, you need to open up more markets for us overseas, tea, coffee, China, India, Turkey. India, for instance, has a total ban on Kenyan flowers. It has high tariffs against our horticulture produce. David, you've got to talk to your trade department. We've got to have more trade treaties talking. I don't think that department is running very well. We need to be more aggressive looking for markets. China has been very good for us. The second one is you talk about value addition. I'm very happy what our friends here are saying about financing the value chain. NCBA, Equity Bank have been very good at funding, not necessarily the farming of it, but machinery finance, tractors, trucks, moving stuff around the country. There is a problem in classification of what goes financing into agriculture. As you know, the central bank definition is too narrow. They say only what's going in the farm. But if a bank lends to, for instance, a truck owner who transports produce around the country, they call that as transport, not as agriculture finance. So there is a definitional problem around what is agriculture finance. So some of these big things that we need to talk about. VAT on machinery. Why did you bring VAT on agriculture machinery? I don't get it. You're meant to encourage value addition in agriculture, then you put VAT in, you put VAT on all these inputs. Ring fence, David, ring fence agriculture, some of the stuff. It's so important to this country. By you getting a little bit extra revenue from the agriculture sector, it doesn't add much to the overall kitty, but it does disturb, with the direction of strategy that we are working on. So finance the agriculture value chain, very important. Everything in it will give you much more sustainability once the rainfalls sort of slow down, maybe next year after. Obviously, it's a cyclical thing.
Thank you for that. Before I come to your closing thoughts, allow me to move to Wanjiko Manyara here from the Petroleum Institute and really to get your sentiment on the presentation that was made as well as consumer sentiments on the ground.
Wow, thank you. I was not expecting to speak right now. And thank you, David, as usual, for your very insightful conversation. And I'm just hoping that we can get other sectors to listen to where we are midterm so that hope can be retained and investors can continue trusting that what they are planning to do and what is already on schedule, they can actually put it on schedule. One of the areas that I'd just like to speak to is with respect to the infrastructure fund, and now with the support from the IFC as well, it's capital intensive. And one of the trade-offs that we can have, because we import all our oil net, is to make sure that lubricants, greases, coolants are actually procured locally. Because we have 5 state-of-the-art local manufacturing lubricant plants. Yet, the growth in that very important segment is been very slow, recognizing and appreciating that indeed, finally, we did get the National Treasury, the Ministry of Trade and Industry to come through in reducing the taxation, the import duty on the raw material. And we are already seeing the growth. There's been an order, yes, they were already benefiting from that because there's a 10%, the DRS is now on course. It took very many years of advocacy, but finally it's now come through. I know we are dealing with illicit trade, but it's already on. So the trade-off would be for the government to ensure that there is preferential procurement of what we produce locally so that we do not import the expertise that works on our infrastructure, and at the same time there's flight capital for consumables, and we have local manufacturing plants that can be used to the capacity for which they're established so that we create the jobs. If you look at the lubricant sector itself, apart from the 1,000 direct jobs that it also offers other jobs. If you think about the containers, if you think about the labeling, if you think about, I mean, there's so many things that have the domino effect. The other area is on liquid petroleum gas. You didn't speak a lot about the strategy for the LPG growth the government has already started implementing with the 10 million cylinders, cost-subsidized cylinders that are supposed to go to the households. Thank you for listening to private sector, because you're not importing the cylinders, you're actually going to utilize what is locally manufactured. So that's another trade-off that has come out. Yeah, and well done, really. We really must recognize that. And what we can do in addition to that, because we know that we have bust the myth, the issue of access to LPG has nothing to do with affordability. What needs to happen is that there needs to be sufficient number of safe cylinders that are accessible to consumers not more than 5 kilometers from their residence. So what needs to happen is to make sure that the laws and regulations in the LPG segment are enforced fully. What also needs to happen, and we have a beautiful case study that was done by the Clean Air Africa, education and awareness. In Uasin Gishu County, leveraging on table banking, 250 women converted to LPG on one day. What was their worry? How do I access my next refill when the one that I have now runs out? And the issue is not investment in the cylinder, in the storage and refilling plants. No, it is in the number of safe cylinders that are in circulation, which means dense distribution and retail network, which have a domino effect of getting the youth and the women employed in that value chain as distributors and also as retailers.
Asante sana Wanjiku Manyara. Let me take closing thoughts here. Let me start with Jess, then Doc, then Kwame. And Kwame, now this is the point to go for the FX question.
Okay, so I'll start. So I think the space that we're in right now is really positive and it's encouraging. We see, private sector credit as a key element to development. But really, the real opportunity lies in how we're able to accelerate and actually amplify the flow. And that's why there's really need for us to focus on sectors that will potentially drive jobs and inclusivity. And I'm really happy to say that at IFC, we are doubling down on these priorities. So we're leveraging, innovative partnerships. We're looking to catalyze investments to turn private sector momentum into a much more broad-based solutioning. And just maybe finally, just to re-emphasize that IFC is investing in Kenya's financial sector. It would be amiss for me to be at a bank event and not highlight that, John. So we'll continue to partner with banks as well as other fintechs across. But also we are keen on seeing how we can support the digital lending platforms. And also we're really, really keen to see how we can support more women entrepreneurs and support the transition to green. Thank you.
Doc.
So again, I want to reiterate, I think the government has got it right this time. And David, to be honest, what you guys have done in the last 12 to 18 months is excellent. Some of the hard decisions you've taken. I have a wish list. It's my job to have a wish list. One, please make fertilizer zero rated again, and farm machinery, make it zero rated on VAT again. Second one, Ken Trade, UCR. David, you know this one, $10. You promised us 300 shillings. It's been minuted at PRT. Just bring it back to, please tell them. UCR, bring it to 300 shillings. You promised us many times. And the final big growth industry, John, for your bank is the meat industry. It's massive demand. We're not getting it right. There's not enough funding going into the meat sector. I met Carrefour MD. I met Carrefour World MD last week. There's massive demand for meat in Kenyan supermarkets. But Carrefour, Dubai, South Africa, they want Kenyan meats. And what he did about vaccination, we 100% agree with it. It's an excellent program of vaccination our meat. There's not enough funding going into the meat sector, which means that the players are small. We need to find them to aggregate or make them bigger players in the meat sector, livestock sector. It's unlimited demand. I think we spend too much time on crops. Let's focus on livestock. David, you know the situation, right? These three are my wish lists: VAT, Ken Trade, and the meat sector. Please, thank you, guys. Thank you.
Thank you, Kwame.
Okay, I think, yes, there's no gainsaying the fact that stability, macro stability is essential. There isn't. Whether you're on public sector management side or in the private sector. There isn't. I've always been under the impression that the Central Bank of Kenya practices something that is called inflation targeting, which is basically to try and keep inflation within a band, and that band is 5% with an adjustment of 2.5% on either side. If that is true, then the reason, actually people call it stable, but I actually think that the stability of the Kenya shilling is leading me to ask whether the central bank still practices, or the monetary policy still privileges inflation targeting. Now, this is what I and some of our colleagues did. We took 4 other countries outside Kenya who are also known to practice inflation targeting, and that's the US, the Japanese, Australian dollar, and the Canadian dollar. And we started to measure their volatility by day over the past 15 months, coinciding. And one of the things that we've seen is that the others tend to fluctuate around about 1% per day over time, going one way or the other, depending on what news there is. And then Kenya, after, I think, June or July last year, about September, has been extremely stable. Not just stable, actually, hardly moving. You can't see. It was quickly after that, and then it's just been up there. That leads me to thinking that it leads somebody who's reading the numbers, the witchcraft, as David called them, to think that there's some pegging of the Kenya shilling to USD. And when you have a peg, if that's true, but the point is not whether the central bank intends it, but the effective thing is that it's a peg. When you have that, then inflation targeting becomes a problem. And so we asked ourselves, how many targets are being pursued? Because you can't be talking about a peg at the same time as you're trying to go inflation targeting. So that's where the conundrum is for us. And when you look at inflation as well, and part of that is that if you take out the core and the non-core inflation, you're really thinking that the part of the reason inflation on the core side is actually very low is because demand is weak. And if you try to annualize those numbers based on the September declarations, you're actually seeing that it's actually below the 2.5 for some items. And that's, in my view, not necessarily a good thing. So the story in itself is still witchcraft. It doesn't fit for us to say central bank is still doing inflation targeting, but at the same time, inflation is here, and that we have a very, very stable shilling. So that leads me to the thinking that whatever it is that is happening with the Kenya shilling is something we need to observe and study very, very clearly. Because whichever witch doctor that is, he's very effective for now.
Witchcraft. Any questions from the floor? I'm happy to take 3 quick questions, and then we invite David back on stage to make his closing remarks. Going once. There's a hand at the back here. Please introduce yourself. Oh, there's a microphone there. Tell us to which institution you're affiliated and shoot 1 question, just 1.
This is Kiara. Stephen Maleche, all looking at the dollar shilling. But
maybe the witchcraft is working.
Anyway, away from voodoo economics. We are all looking at the dollar shilling. But if you are to look at the dollar versus other currencies, it has weakened. If you look at the shilling versus the pound, the euro, everything else, it has weakened over year to date. So maybe it could just be that the dollar has weakened against everything. You can see it on the other currencies, but you're not seeing it on the shilling dollar exchange rate.
Good perspective there. There's a variation in terms of behavior. Any other? There was a hand where? Right here.
Thank you, Julian. And thank you, Dr. Andy, for your presentation. I'm Purity from Abojani. So 1 question. I was expecting to hear maybe Dr. Ndi's perspective or opinion on matters spending bills and the plan when it comes to that, because yes, we are seeing private sector credit increasing, and the issue of pending bills continues to strain private sectors, institutions and SMEs in terms of cash flow, and it has been a long-standing issue. A while back, there was information that there was going to be a bond to to feed some of those bills, but we've not had any more insights on the progress. So I'd like to hear from him on that.
That program kicked off, I think, but maybe Dr. Ndi can give us more color into it. Ladies and gentlemen, let's appreciate the panel for their insights on the macros. I will usher you back to your seats. Asanteni sana, Doc and Jess. Okay. Let me call Dr. David Ndi back to the floor to respond to issues, including the one I started with Doc around the IMF program and the World Bank DPO.
Do you want me to sit or to? I can stand here. No, let me sit. Let me sit. I think so that I can use my notes. Thanks. I think that's excellent issues raised. I think Kwame, thank you for always pushing the hard. Wishing the hard issues, they're bringing them to the fore. I hope I can, if I don't capture everything, forgive me, but if it's very important, please remind me, because it's not always easy to get a hold of everything. The question of tax, is it realistic? Can you capture those hard to tax people? Let me preface this with something provocative. Just a few weeks ago, when we were launching this SEZ, good friend of mine, Professor Carlos Lopez, an economic historian and a great sort of public intellectual on African development, was on the panel with the president, and he said three things. He said the three things that drive development of a country from a leadership perspective is is in his studies, is three things. Number one, ambition. Number two, focus. You have to decide on what you want, the key things, and you focus. Number three, alignment. Align the people and the institutions and whoever you need in political alignment to do that. The hardest of those is ambition. And Kenya has a serious ambition problem because we have a comfortable elite. And ambition is disruptive. So when you pronounce very ambitious things, the reaction is it can't be done. Yeah? So we don't look at, there is no development experience which is not ambitious, and there is none which replicates a historical experience. So every development experience is an innovation. You have to innovate your own path. Yeah? So history is no guide. Current situation and challenges are no guide. Your job is to overcome them, not to be limited in your ambition by your current challenges. So let me talk about revenue. I promised in this forum, and we have told our institutions many times, that in a year or two, most of our taxes will be collected by algorithms, not by people. So we are not planning to collect taxes the old way. Why are we able to collect taxes by algorithm? For two reasons. Because of AI and the amount of computing power that you can now deploy to reduce the transactions costs. that make those areas called hard to tax. Number two, because we have the good luck or good fortune, because it's not luck, it was designed, to have perhaps what is the highest penetration of digital finance in a country at our level of development. Every Kenyan is on M-Pesa. Our economic transactions are observable. The limit to ability to tax has been that you cannot collect very small taxes manually because the administrative burden. And that to collect taxes from these small people, small taxes, we have to go and squeeze them the traditional way. You don't have to. You can do it passively. Yeah? Let me give you a hint. If you go to your SHA website and you are not on payroll, it will ask you what you have to determine your premium, which has to be 2.75% of your income, but you are not on payroll. So how are we determining the premiums of that non-formal people? If you go there and put your ID, it will give you an annual premium. How did it arrive at that annual premium? There has to be an income assessment. We have the capability to assess incomes of people in the informal sector already. And we are leveraging on those two things, AI and digital penetration. So we have we have already a machine learning model which does health premium assessments. We have another machine learning model which calculates credit scores for people on Hustler Fund, and we are building one to do tax assessment. So when I say taxes will be collected by algorithms, maybe because of lack of ambition, we don't actually think that we can leapfrog existing systems. Even when we did M-Pesa, nobody saw us leapfrogging existing systems. We will leapfrog the traditional model of tax collection. Now, coming to numbers, I think again, if you look at our numbers, I said we have done our assessment. Our target is not 25, 26. Our number is 22. And we are giving ourselves 4 to 7 years to do it. We can do it very quickly, but that can have a big shocks on the economy. So we are phasing it out. But 22, we don't think it's unrealistic. Our macro framework tells us that if we are doing 22 revenue tax, you can spend 25 because we think a 3% deficit is financiable, especially if you split it 50-50. If you're only financing 1.5% of GDP domestically, I think you're doing a good job of not crowding out the private sector. Yeah. But we are not planning to go after people using people. When I said we need to carry our institutions along, even KRA, that is a huge paradigm shift, that their job will not be tax enforcement. Actually, we were having that conversation with them yesterday. Now, from our estimates, because we have the analytical tools now to do it, when we talk about the people who are we talking about tax? Again, I mentioned here, our estimate is that there are 2.5 million taxpayers out there with equivalent incomes to the people on payroll. They are doctors in private practice. They are and if people are in the same labor market with the same capacity, the same education skills, it follows that because you are in the same integrated labor market, what people with a certain who are in this room are earning, the people who are not on payroll with exactly your profiles are earning about the same. Proof, go and check where they live. They live, they are your neighbors. So how is that? So it follows, it doesn't take much to think that if you have 3 million people on payroll, you have an equivalent 3 million people not on payroll with the same incomes. And that's what our data is telling us. So we are not going to squeeze money out of Mama Mboga. That's one side. The other thing we are going to do, which is very radical, which technology allows us to do, is to change the way we collect. We give VAT benefit. Right now, and it speaks to some of the, and the question was raised about VAT rebate. The big challenge with VAT is that we want to give citizens a benefit on essential goods, bread, milk, all sorts of things. But the way we do it now is either by exemption or zero rating. So you're giving the rebate to manufacturer with a view that they will pass it on to the consumer. In so doing, you create something called a VAT refund, which is very problematic. Technology allows us now to give that rebate to the consumer directly. So you can charge uniform VAT to everyone, but when somebody goes to the supermarket and you get a fiscalized receipt, technology allows you to see which items have got a zero-rated VAT, and immediately we give you a tax credit for that amount. For us to give you a tax credit, you then have to be a taxpayer. So you want to onboard people on the tax net, either for purposes of paying tax or for purposes of getting tax refund. So if you're below the tax net, you will want to register so that you will actually get a tax refund from the government for the VAT you have spent directly, instead of it going to a manufacturer who is supposed to pass it on to you. So let us not think about the old system. You can do this without inflicting pain on people. I mean, I've been on that side. It would be foolish of me to go to governments to do exactly the same nonsense that has been going on for decades. Yeah? It would not add any value if you are not bringing insights of how you can do things differently. So yes, we think that expanding the tax base is doable, because once you then create a carrot for people, because the low-income people will say, even if I'm going to a kiosk, I want my VAT rebate, and I can see it immediately, the way you get a duty-free refund when you shop in particular countries at the airport. So everybody should have a tax account in the tax ledger. So you get an SMS telling you you've bought 6,000 shillings worth of good, 2,000 of them are VAT zero rated, your tax credit is 300 shillings, and pop, it goes into your tax ledger. By the end of the year, you will file a tax return so that you can get a refund, not so that you can pay tax. Tell me why people will not do that. Technology allows us to do it at very little cost. So, ambition. People, let's be ambitious for our country and for ourselves. We have capabilities that can enable us to do these things. The fact that we haven't done them in the past, every development experience, you have to be a trailblazer. You have to believe that we can be trailblazers in some of these things, because certain stars are aligned in our favor. On privatization and agriculture, I think the questions of whatever, but let me speak to my friend about the issue about the VAT and chemtrade and all those things. A couple of years ago, I was speaking to people as we were doing the mega infrastructure things, and I said, you know where this is going to end up? It's going to end up in a revenue crunch for the government, and when governments have a revenue crunch, taxation becomes very capricious. So we have two problems with our tax system. One is that revenue pressure. So you have a very capricious tax system. What happens is when government is under intense pressure, it taxes the easiest thing to tax. One of the easiest things to tax is trade. It is the worst thing to tax. But unfortunately, that's what they taxed. So one of the imperatives of broadening the tax case, so for example, we see how we can tax more high income and wealth, is so that we remove the pressure to tax trade. Yeah. Because now all those regulators have been given innate targets. Because tax is not coming, it is now fees and levies. So every one of them now has a license to put a levy on anything. And if you try and tell Treasury that these things are distorting the economy, you have to choose. Is it revenue or is it debt defaults and many issues? So that's one of the things. The other problem we have, quite frankly, is industrial policy, what you're calling the tax regime. We are not agreed on industrial policy. Our industrial policy is very incoherent because we don't have tax regime being incoherent, being uncertain and unpredictable is because we have an incoherent industrial policy. Some manufacturers want incentives for domestic import substitution, so they go and lobby for that. That hurts the others. So the private sector itself, it is just a Tower of Babel. So, but that obviously means that government has a lot of work to do. Industrial policy is very difficult because so many interest groups want so many different things. So, but we are trying to, but that's a very hard nut to crack, I'll be honest. But it makes easier when you don't have revenue pressure. So hopefully by reducing the revenue pressure, you'll be able to do that. LPG, preaching to the choir. We were sidetracked a bit by some friends of ours called Saudi Arabia because they had promised to fund that program because they have a thing on clean cooking. It's gone this way for a long time. It's still somewhere in the works. It's tied up with problems with carbon credits and many other things. But yes, we do intend to roll out. We have now decided to start it on our own. And then they can whatever. And the goal there, we have three objectives for LPG. One, as we said, is penetration. We want to reach. We now have about 20% penetration. We think we can reach universal penetration. That means putting another 8 million households. We have 12 million households. About 4 million are on. With putting another 8 million households on, increase per capita consumption from 7 to 15 kilograms per capita. It's a huge economy down there. But so penetration is one, but once you do that, there's something you must do, which we didn't do properly before, is regulation for public safety. That's why you get all these places exploding. So public safety becomes very important. Hence the thing about what kind of leaders, you can deploy a lot of technology there. But the reason why you have a public safety program is because the capex for cylinders, the operating capital is very expensive for the little guys. So you need to find a way of doing that. And then market structure. We had a bit of a cartel structure problem there, which I think also has to be dealt with. But I agree with you. On the question of the gentleman that's about the meat industry, I agree, absolutely. We are also trying to work hard. Just a couple of days ago, some people showed up and they said they have a market for beef in China. And potentially they can buy 2,000 carcasses a day. Now, 2,000 carcasses a day is 700,000 animals. We don't have them. Our total slaughter is 2.5 to 3 million. So we need to raise productivity very big time. To have an offtake that adds another 700,000 animals actually is a big, and that's only China. And of course, one of the things which is coming on stream, someone talks about various agricultural markets, is China has given us Africa, whole of Africa, a free trade, a zero tariff on everything. We are actually in the process of discussing that trade arrangement. We're already doing well with China on avocados and a couple of things. China could consume all the coffee we can produce. So with China in there, you're probably never going to exhaust your potential to export coffee. So there's a huge opportunity there. But we need to up productivity, hence the things I'm talking about, so that you can increase the carcass weight of your animals, you can increase their nutrition so that you can have a higher offtake. I think the scope there for whatever is very, very significant. And people are coming. Many people say we want to buy. Indonesia gave us an offer for 200,000 live animals a year. We couldn't supply. So its market is there. We just need to do a lot of work there. Finally, Kwame, on inflation targeting. Pending bills. Pending bills, we've had a challenge because of two things. One, audit. Even if you are to do an instrument, you have to verify the bills. And there was a huge amount of fake things and all sorts of things. Out of the 600 billion shillings you are told are the pending bills up to 2022, so far the UCO team has only verified 250. Of those, 80 is roads, which you've done. So the actual verified is 150 billion shillings. The good thing is, the good news is, of those 150 billion, there's about 120,000 people claims in there. Of those, about 90% or about 100,000 are of 100 million shillings and below. But when you total them up, they come to about 50 billion shillings. So they are eminently payable. The also challenge we had is what kind of instrument do we do that does not count as debt? It's taken us a bit of work, but I think we figured out a securitization that does not add to your public debt. It's quite an innovation to do it. But it is something that actually is, in the end, when you look at it, is very simple, because under the PFM, ministries are required to pay last year's bills from their budget allocations. So there's a mechanical you can use there under the PFM, which is on the expenditure side, to securitize on the expenditure side, which doesn't go into your revenue side, which is where you normally have a debt issue. So that is something we probably hope to close quite soon and do a lot of things which will then prevent pending bills from occurring in the future. Yeah, but that is in the works. It's also a function of the fact that your priorities was to deal with debt, not to add debt. We have big problems on securitization with the IMF, so we just don't want to complicate them more than we need to. Finally, on inflation targeting, Kwame, I'm afraid I have to take you back to a macroeconomics class. Yes, our policy is inflation targeting, but the question is, which is your instrument? Is it interest rate or exchange rate? Yeah, you're familiar with the trilemma. So the big question you used the wrong countries. The big question in developing countries is which is your instrument. In developed countries, it's very simple, it's interest rates, because you don't have the kind of exchange rate, whatever. So there is a lot of very good literature, particularly on Indonesia. So look it up on whether I think we say our instrument is interest rates. But when you try and uncover what we actually do, if you do a model, it flips between the two. Sometimes we use exchange rate, sometimes we use interest rate, and that's what I was calling common sense. If you get stuck with a template based on Canada, that is the direction I was talking about, witchcraft. There's a lot of imported inflation. Exchange rate is given you a sort of shallow markets for these things. You don't have a transmission mechanism that is guaranteed. So if you want to, and the answer to your question is, if you want to study the data, look for switching between interest and exchange rate as the instrument for your monetary policy. So I hope I have responded to most. questions. IMF program, neither here nor there. We're having a conversation with IMF. Do we need a program? I don't think we have a meeting of minds internally on why we need it. But that is because of uncertainty. Yeah. What if, do you need one if you have a shock or, yeah, there's too much uncertainty. But on the long haul, I think I am personally very categorical, and I think that one we are aligned, all of us. It's a question of time. That our goal is to transition from lower middle income to upper middle income country. Part of being an upper middle income country is more market facing than multilateral finance facing. So even if you listen to policy, you'll hear, so again I said, my target for stability is not relationships with the IMF, but relationships with the market. So the KPI that I would like to see better is the sovereign credit rating. So an investment grade rating is what I see as appropriate focus. But what we do in the intervening period, we may have an IMF program. If we have a shock, you will have an IMF program anyway, because you are a member of the IMF and you are entitled to a standby arrangement. Whether we need a PGRF and these other structures, I think it's a question of what structural reforms are we supporting and are we aligned with the IMF on that? We are not aligned because the IMF is very much preoccupied with demand side things. And we are much more focused on supply side, and the IMF has very little view of the supply side and what we are doing and the impact of supply side on your macro outcomes. But the conversation continues.
Thank you. Thank you, Dr. Ndi. Don't even leave stage. We want to appreciate you. Let me call Group CEO John Gashora to come and do that for us. Receive it from here. We're appreciating you with that token. Yeah.
Always.
Yes. Camera crew, let's be ready, please. John, the floor is yours. Thank you very much, Dr. David D. Let's appreciate him one more time for his insights. Asante sana. Thank you as always. Appreciated. Asante. I'd also like to call my panelists. Remain on stage, Dr. D, please. My panelists, Kwame, Jess, and where's Doc? He stepped out? Oh, he's left. All right, we'll still appreciate him. Let's also appreciate them. You can go to that side. So we'll take a nice photo. Then we'll have a group photo. And you can come to this side, maybe. Yes. All right. Thank you very much. Oh, this way, please, sir. Not yet. Yes. All right. Asante. Kwame is next, and then we shall have a group photo there. Oh, not yet. Just let's have Kwame first take his. Now we have the group photo. Please, now let's join in. Nice one. Nice one.
And go for it. Okay. Thank you.
Asanteni sana, and thank you so much for staying with us up to this point. We are at the tail end. Let me call the Director, Corporate Banking, Charles Omondi, to give us the vote of thanks, and that will be it. Charlie.
So good, I think, morning. Thank you very much. I'll make it very, very brief. It was supposed to be a breakfast, and we are turning towards lunch, so we'll make sure we finish in the next 2 minutes. But to our customers, thank you very much for gracing this occasion today. This marks the 10th edition of our Economic Forum. So asanteni sana for spending your time. I know one customer rushed out, said, I have to go and make sure I can make so much to pay your interest. Today is end month. So I did let him go. To David, Daktari, thank you very much for the thought-provoking session. I know we are all here. Normally, by this time, many would have left, but everybody wanted to hear, what will David say? So asante sana for gracing the occasion today. To John, thanks a lot for your support for this economic forum. I know we all find it very engaging and customers appreciate it. So thank you very much for that good support. To my colleagues, our MD Kenya, James Karibu Sana, and I'm sure that going to the next decade of this forum, you'll really enjoy it. I'm sure my customers here have seen very many. Dr. Chepkoni always loves staying behind. So asante sana, and very many customers who are here today. To my colleagues from NCBA, our senior leadership, I've seen you here today. Thank you very much for gracing the occasion too. To the media, asanteni sana for putting the brand out there, ensuring that we are able to communicate to our customers, to communicate to the whole country about NCBA as a brand to watch. To the coordinating committee, our marketing team led by Nelly, Susan, Jackie, asante sana. Susan told me not to make a comment today. Thank you very much for sending the brief very early. Okay. And our partners today, Oxygen, the Deskmen. I know technology was not on your side today, but it always happens. It can disappoint you when you need it most, but we made good with what we have. So asanteni sana to Serena. Always a pleasure coming here. Your hospitality is just too warm for us. So that's why we are still here. It's a bit cold out there, but we'll still be here, but we are not staying for lunch today. So to my colleagues from NCBA again, to the corporate banking team who are here, asanteni sana for being here today. And last but not least, our moderator, asante sana. Asante sana. It's always a pleasure when you're here. And I'm sure I also thanks our panelist, Kwame. I'm sure today I felt like I was in an economics class. So very nice. Jasmine, asante sana. I know Dr. Bimal left. Can see my neighbor Hassan. I don't see you jogging in the morning, but I'm sure you are very fit. So to everybody, to wish you a very nice afternoon today, and we'll be back next year, probably bigger. And I'm sure David will want to promise something better. He's given us 18 months, so we'll want to get an update. Where are we? So asante sana. Rafael, of course, we really, really appreciate, and thanks a lot for the support from the global markets team. So to everybody, if I've missed you, I want just to say thank you, thank you, thank you, and do have a lovely afternoon. Asanteni sana.
Many thanks, Charlie, for closing it for us. Friends, we are adjourning at this point. I believe there's still some biting out there, so please check. You're free to leave at your own pleasure and leisure. Thank you.